Our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Send to Congress an urgent budget request to fund America's national security needs, to support our critical partners, including Israel and Ukraine, is a smart investment that's going to pay dividends for American security for generations.
The President of the United States, an address to the nation last night, a rare 15-minute Oval Office address from the President of the United States, setting the groundwork, laying the groundwork potentially for $100 billion of resources from Congress. How difficult that will be to achieve remains to be seen. From New York City, welcome to the program. Your equity market on the S&P 500 negative here by 1/3%. It yields lower by 4 or 5 basis points, backing away from multi-decade highs on a 10-year yield, 494.14. If you're just tuning in, Tom, really, really close to 5% earlier, 499.20.
Backing away from where we were a couple hours ago. But John, I'm going to say there's no respite here. It's completely driven by news. And as Oliver Crook said in Tel Aviv, there's minimal news about any military effort other than those Yemen missiles that were taken out by the U.S.
That just speaks to the risk of U.S. involvement, doesn't it?
Minute by minute.
Events of the last 24 hours.
Yeah, absolutely.
And the humanitarian issues as well, Tom, that's going to become a bigger and bigger problem.
Yeah.
U.S. and Europe pushing for that aid to get into Gaza. And the Rafah crossing, as far as Ollie is concerned, in the last hour or so, still closed, that link between Egypt and Gaza.
And this is the southern border. Lisa, what have you studied on that? I know you've taken a look at that.
I just want to understand why it hasn't opened, what the holdup is, and honestly, how quickly people are running out of water.
Yeah.
I'm reading the reports and just wondering, are people going to actually start starving and dying of thirst? And that, to me, is just a catastrophic outcome.
My amateur take, which is, I don't think, really been done up correctly, is we look at Gaza as a homogeneous entity, and the answer is northern Gaza is much more urbanized and affluent than the fields of southern Gaza. So that's even more reason to bring the humanitarian effort in. Right now, we're going to get a brief on this. So we've done with surveillance with this war is try to speak to experts. Daniel Tannenbaum is global anti-financial crime practice leader at Oliver Wyman. He is expert in the idea of sanctions. He's also at the Atlantic Council. Dan, thank you so much for coming in for a brief this morning. Are Hezbollah and Hamas, are they entities that you can sanction?
I mean, they have been sanctioned as terrorist groups for years, but they're non-state actors, largely. So it's not like there's uniforms that people are wearing, that there's a directory of officials, save for some of the top leaders of those organizations. You're really left to try and identify people that may have a connection, that may be supporting them. There's companies that are trying to provide supplemental data to banks and payments companies to try and make sure that you're rooting out any Hamas or Hezbollah-related payments.
If we say the money comes from Iran, fine. Is it in suitcases? Is it a Matt Damon movie? How does the money actually move to support their military efforts?
I mean, cash is fungible, which one party in the U.S. government started talking about a lot over the last few weeks. I think it's moving a bunch of different ways. There's crypto-related funding that's come out, and the U.S. government has worked pretty actively to try and thwart any crypto-related funding of Hamas and Hezbollah-related efforts. It's physical cash. It's commodity. It's a whole bunch of different ways to fund the effort.
Did America turn a blind eye to Iranian crude production?
It's been an interesting 2 years if you look at what's happening, obviously with the crisis in Ukraine, the sanctions on Russia and trying to pull some Russian oil off the market, to a limited extent. I think the U.S. certainly wasn't as focused on enforcement of Iranian oil sanctions to keep some of that oil on the market. The dynamic you see now is Iranian tensions are increasing, Venezuelan sanctions were eased on Tuesday, and in the next few months you'll see Venezuelan oil, which is largely the dirtiest oil in the world, come back onto the market, maybe not at the same scale you need. But in short, yes. But this administration has done a very good job of doing the calculus of not cutting off its nose to spite its face, especially when you look at energy prices, which are the most tangible reality of impact of some of these events.
This doesn't feel strategic, though, in the long term. It doesn't feel that way at all. So you've got two conflicts taking place at the moment, potentially a bigger one set to take place soon. You've got Ukraine and you've got Israel. The immediate response to Ukraine was to absolutely drain the SPR to multi-decade lows. And as you've alluded to, not quite said it, but alluded to it, they took their eye off the ball regarding sanctions on Iran. Arguably, because of domestic politics at home and the price of energy. And now what are we doing with Venezuela? Are we sitting here saying it's a coincidence? Just a coincidence?
It's not a coincidence at all.
So what do you think about the long-term strategic aims of sanction policy in this country by this White House, based on the very fact that we seem to be responding to short-term energy issues?
I mean, unpack what's happening right now. You have Russia's invasion of Ukraine, again, that's drifting into the second year. You have U.S.-China issues that continue. You've now got this crisis in the Middle East with the attack on Israel on October 7th and the associated response. All of these are connected, and the common theme is the energy market in terms of looking at who's buying what from where and how to manage some of the domestic expectations.
Do you think that the U.S.'s unwillingness to push oil prices higher is part of the reason why the U.S. is not taking a harder stance right now with Iran?
I do think that's part of the calculus here. It has to be. When you look at what's been happening, if you look at what OPEC Plus has tried to announce with trying to limit some of the supply to keep prices intentionally high, it is a balancing act. There certainly has been enforcement of the Iranian sanctions, but we've known that China has become a larger and larger purchaser of Iranian oil, and there's been no consequences to that. But I do think it's all part of, there's a broader calculus that they're really trying to look at because all these conflicts hang together.
One of the confusions of trying to come up with a narrative right now is that what you feel and the narrative that makes sense to the emotion doesn't translate on the ground with the flows of money. And yesterday I was reading a Wall Street Journal article talking about how a lot of the money that Hamas got was from humanitarian aid, was from what people from the U.S. and Israel gave to the Palestinian people, that a lot of the borders that were opened were then taxed that much more by Hamas. How much is this one of the main obstacles in actually getting help to innocent civilians who are really struggling?
I mean, we saw this challenge in Afghanistan for years where aid was getting misappropriated by the Taliban, especially since the U.S. pullout, and that's been part of the challenge in putting aid into that market. That is the real threat when you're dealing with non-state actors that have every desire to try and seize upon Western aid. This is what you end up seeing if that's siphoning off of aid. It's critical for charities to do diligence on where money's going. But again, in that non-state actor scenario, you may not have clarity that some of these actors on the ground that claim to be doing good are really fronts for Hamas and Hezbollah.
Dan, you mentioned this is a really key phrase, maybe the best phrase I've heard this week, drifting into another year. I've been reading Kitchener, World War I. The British were certain it was a 4-month war. That worked out. This is not 73. Forget about 48. It's not 73. It's not 67 for Israel. Are we completely misjudging the short-termism that is the human condition of the beginning of a war?
I mean, you've seen a lot of attention with Rishi Sunak, with Biden, with Blinken parking himself in the Middle East over the last week. I think there's every desire to look for a proportionate response. And to your point, Lisa, I think it's tough to balance some of the personal and on-the-ground dynamics of this. I mean, realistically, there's every attempt being made to try and stave off a further significant attack that further draws away support from Israel. And I think that is the dynamic that the U.S. is trying to face along with its allies and trying to work with the Netanyahu government to think about a response. It's hard to separate that emotional response to not over-escalating something that draws Iran and other proxies into a broader war in the region.
What is a proportional response to this?
I mean, you know I can't answer that. I mean, it's tough. You've seen thousands of people killed on the Israeli side, thousands of people killed on the Gaza side that were not all Hamas. I think the proportional response is really ensuring that this doesn't drift into a larger Middle Eastern conflict, and however that ultimately comes about.
Dan, it's good to see you. It's good to catch up. Really difficult conversation.
Really.
Dan Tannenbaum there of Oliver Wyman. TK, this stuff is so complex. So difficult.
The complexity's there, and it's been there in history. And the question to me, and this goes to Lisa's discussion of the humanitarian immediacy of this weekend, is this is not the same. As a media war, it's a completely different formula for the politicians, and dare I say, for the military as well.
Although, in fairness, every war has been marked by propaganda. World War II was marked by massive propaganda, which we studied in school. The question now is, when we look back at this war, how do we pair propaganda without it becoming sort of the catalyst for a wider conflict that embroils a wider number of potential state actors?
The blast of that hospital earlier this week, just a fantastic example of what you're speaking about, Lisa.
Exactly. And this is what people are talking about. What does the truth matter if people won't care what the truth is, and they're going to go with the narrative that works best to deal with their population?
Is seeing that play out not just abroad but domestically as well. Alex Brazier of BlackRock is coming up shortly. Your equity market at the moment on the S&P pulling back just a touch. We're down about 1/3 on the S&P 500, heading towards a week of losses. From New York, this is Bloomberg.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
we are still very much in a late cycle economy.
I think the Fed keeps rate higher for longer until they get a recession.
High for long will still be an important part of the narrative.
We're going back to 2%. The Fed is absolutely capable of getting us there.
I think the worries are going to come for next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. What a week in this bond market this morning. Very close to 5% on a 10-year yield. The high of the session, 499.20. In the equity market, TK, negative a third of 1% on the S&P. The stock market heading towards a week of losses. On the bond market, yields up by more than 30 basis points this week.
The separation here has been huge. The non-correlation is off the chart. We've got a gentleman from BlackRock coming up to talk about that. Equity market, is it a bull or bear market? I don't know. Bond market, we're not having a debate. It's a bear market.
It's a bear market.
It's a bear market.
Have we fully realized the pain associated with those losses, Tom? Keep going back to the same question in the bond market at the long end.
No, I don't think so. I think Lisa's done a great job on this. I think I look at every real estate transaction as well, and the answer is there's much more to come. I go to the Credit Suisse article, Jack Sitters today, where Credit Suisse marks down their flagship real estate fund 9%.
To your point, Tom, and I think it's a really good one, and John, to your question, have we realized losses? No, because we haven't had mass selling. We haven't had institutions fully move away from bonds in any material way. How many days, how many months, how many years have we heard people come on and say 60-40 has been torpedoed for now, but It looks even more attractive next year, right? We've seen this, but this will be the third consecutive year of bond losses, which has never happened in history before. So at what point do you start saying, well, does that dynamic change?
Not on a Friday to have the brain freeze over. My brain's already frozen over, but let's let it go and look at this. And here's what I would say. The whole rationalization right now is mark to market versus we'll own it forever. Someday it'll be back to maturity. Not a single pro has told me that's valid analysis. You've got to do a net present value duration analysis. And if your portfolio is at 15 years, John, there's a 7, 8, 9-year tip point where it's oops.
There's still 2.5 months. Still 2.5 months. Could still work, couldn't it? Kinda.
What kind of losses are we talking about? Hold on a second. I'm going to start.
We're interviewing John in the 8C.
I think we've had like a 170 basis point move off the lows on a 10-year yield in March. So I'm not sure whether you can reverse that very quickly unless you get a collapse in the economy and something else happens with the financial system. That's the question for the Federal Reserve. Is it a substitute for further tightening from the Fed in November, in December? The words of the chairman of the Federal Reserve, Lisa, at the margin, what does that mean?
I think it means that he doesn't really want to weigh in on this, and that was his punting.
I sensed the same thing, didn't you?
That's what I felt, because he also said that it doesn't seem like that basically policy is overly tight, is overly restrictive. It doesn't seem like it is hampering the economy in a material way. So pair that with the idea that, yes, it's getting more restrictive, and yes, on the margins, this might do something. It is a wishy-washy, don't ask me, I'm not going to tell you anything.
They're data dependent, but what are they data dependent for? The October jobs report, or are they dependent on what Apple does and Microsoft does in 10 days?
I think the data, without a doubt. I think the economic data. I'm not sure if Apple speaks to the US economy
I'm not looking
quite
for
the
them
same
to
way.
cut rates, but this higher for longer thing, all that's going to be redefined, as you say, John, in the next 100 days, whatever it is to the end of the year.
Until something breaks, and something did break earlier this year, and you saw what happened in the bond market after that. Equities right now on the S&P 500, pulling back on the S&P, we're negative by a couple of tenths of 1%. We're down a third. Yields are lower by 5 basis points, 493.92. Tensions in the Middle East simmering for the last couple of weeks. We've got crude back in the 90s. WCI $90.60. Crude up here, Lisa, by about 1.4%.
So today we get the last gasp of Fed speak before the quiet period next week ahead of their meeting that ends the month of October. Philly Fed President Patrick Harker speaking at 9 a.m. Cleveland Fed President Loretta Mester at 12:15 p.m. What I am looking at is an infinitesimal chance of a rate hike at the November 1st meeting, and that I think they're going to lean into in the uncertainty of the moment. 12 p.m., President Biden is meeting with European Council President Charles Michel and European Commission President Ursula von der Leyen. Curious to hear how they discuss some of the potential tariff battles between the U.S. and EU, but more importantly, understanding how close these allies are at a time of a lot of international conflicts. And today, I'm actually most interested to understand the regional banks. John, you said something did break. Yeah, here it is. And we're going to be seeing the PacWest acquire Bank of California report earnings, Regions Financial, Comerica, Huntington Bank shares, and Aftermarket Western Alliance, which has been under a lot of pressure. These have not climbed off the mat, and we continue to see this. And how much do we see the pain that we see the anecdotes point to in the earnings of some of these banks?
We want a read on the American economy. American Express right now, third quarter EPS 330, the estimate 295. Listen to the target for 2024, revenue growth in excess of 10%. Tom, that stock is up by 2.7%.
And the series of headlines coming out that we'll digest here, of course, we'll have reports for you, Shonali Basak leading that coverage. And the answer here is simple. You've got double-digit nominal GDP feel running through to revenues. And what's absolutely stunning to me is this phrase, total network volumes up 7%. That's just a boom report from
these
American
fee-based
Express.
cards. I'm just going through this. Amex saying fee-based cards accounted for more than 70% of all new accounts it added in the quarter. The chief executive saying demand for our premium products remains high. These elite cards, Bramo, you pay like $500-600 a year for.
I know,
right?
you're just trying to tweak me because you know exactly where this is going. That basically this is entrance to the sky lounges for Delta, and basically this is how you get in. And everybody is going to keep leading into this because it's a cash cow for both American Express and Delta, and you can see similar types of arrangements. You know, this is the future.
I will say, I know we've got to go here, but John, into this earnings season, the great underestimation is the inflation overlay, the GDP overlay, high nominal GDP. Oops, revenues were better than expected.
Stock is up by more than 2% in early trading. Alex Brazier joins us now, Deputy Head of the BlackRock Investment Institute. Alex, great to catch up with you, sir, as always. Let's start here because I know you and the team have put out a note in the last few days about the tectonic shifts that we've witnessed in the global economy and in markets as well. Alex, this regime, how different is this regime going to be to years, decades gone by?
Very, I think, is the short answer. You know, you were debating earlier the end of the Great Moderation. We're pretty clear. We have seen the end of the Great Moderation, and that reflects a different geopolitical environment, a different macro environment. And markets are beginning to catch up with some of that, but they're not really catching up with the fact that, for example, the geopolitical environment has changed absolutely fundamentally. And even if we can't spot the triggers ahead for geopolitical events, including around the Middle East now, we know that over the next 10 years, the average supply shock facing the global economy as a result of that is going to be negative in the same way that for the last 20 years it was positive. So central banks are going to find themselves fighting inflation much more often, even as we get out of this episode.
Alex, you did a tour of duty at the Bank of England on financial stability. It's not appropriate for you to discuss the executive dynamics and the performance dynamics of BlackRock, but you can advise on a bond route that every portfolio of BlackRock, every portfolio Rick Reeder and company has. They're all south. How do you advise your team this weekend on the instability or stability of the bond system?
Well, we've actually been underweight for many years, the long end of the US curve. We saw two things needing to happen. One was a repricing of the average level of policy rates as we go into this regime where central banks are going to be fighting inflation more often. And the other was a repricing of the term premium, which is now taking center stage in the market debate. Those things are now beginning to happen. And we've reached a level, we think, where we've become a bit more neutral in the short term. We see risks now in both directions. But still, over strategic horizons, we remain underweight the long end because there's still not that much term premium. And this is an environment where you've got weaker trend growth, higher level of policy rates, the fiscal dynamics are very difficult as a result, and that's an environment that demands a term premium.
Alex, earlier to this year, we were talking to a number of bond strategists who said 2.5% on the real yield was basically the tipping point where stocks would sell off and it would be this reinforcing cycle. Are you saying that that's not true, that we could get to a 3%, we could get to a 3.5% and be a more accurate term structure for the economy as you see it?
Well, over the longer term, certainly we could go higher from here as the term premium gets reestablished. But I think it's important to note that as the term premium gets reestablished, that's not necessarily bad news for equities. What's strange up to this point is that policy rates have been, or future expectations of policy rates have been repriced. And yet we haven't seen the equity market really respond very decisively to that in aggregate.
So does that mean to you, Alex, that returns going forward aren't necessarily going to be reduced, but that stocks are just going to have higher multiples, that they're going to be a better engine of growth and reliable counterweight to inflation and a higher term premium type of structure for bonds?
Well, I think you see two features favoring equities in the long term. You've listed both of them there. But I also would note that even if it's a challenging environment, the end of the Great Moderation, it's a challenging environment for broad risk asset exposures. Actually, the drivers of the end of the Great Moderation, whether that's geopolitics or the energy transition or demographic change, they're all big mega forces changing the way our economy works. And we're much more interested in those now as sources of return in portfolios.
Alex, I'm absolutely fascinated on a broader view, and again with your tour of duty at the Bank of England, if with the Great Moderation over, as you stated, are we going to have an actuarial reset of our generation, or frankly, multiple generations? Do we need to start thinking about a bond reset to a higher required return for pension investments?
I don't know whether it's a higher required return, but we're definitely having a reset to a higher actual return environment. And this, by the way, is why it's strange that equity multiples in aggregate haven't yet adjusted to what's happened in the bond market. We see yields remaining at close to these levels over the long term, as maybe higher as the term premium gets reestablished, because we're going into an environment now where the Fed, other developed market central banks are going to be leaning against looser fiscal policy than they were in the past, and they're going to be fighting, on average, these negative supply shocks, whether that's energy prices, other geopolitical shocks, or demographic-related labor supply shocks. So returns are going to be higher once we get through this adjustment. We're seeing that now in the bond market. We're going to need to see higher returns in the equity market and a range of other markets as well in the future.
Alex, just quickly, when you and the team use that phrase long term, how many years is that? What are you thinking about?
Well, in a strategic portfolio, we're looking 5 years and out. In a tactical portfolio, we're looking over the next 12 months. And we see over the next 12 months, the risks in the long end more balanced. But beyond that 12 months, we still see the term premium grinding higher.
So when you say high for longer, you're actually thinking about high for maybe over the next 5 years?
Absolutely. And I think that what's interesting in the way the Fed debate has gone is, as people have focused on reaching the peak, the market has then begun to shift its attention to, well, what does the future look like? Where do we go back to as inflation comes down? And actually, we think that's a lot higher than we were pre-pandemic, partly because of the fiscal position, partly because of the energy transition, which is driving higher investment, and partly because, as I say, central banks are going to be, on average, facing supply shocks where they're constantly needing to push down on inflation, which means holding rates, on average, tight.
Fascinating. Alex, thank you. Alex Brazier there of BlackRock. The latest from them, the Investment Institute, and what's going on in this bond market. If you are just joining us, welcome to the program. The S&P 500 at the moment, negative by 0.2%. When we talk about high for longer, let's talk about what the longer means. For Alex and the team, as they look at bond yields at the moment, Bramo, they're talking about maybe over the next 5 years. Get used to this.
And then what? And we don't know what the and then what is, which is just yet another layer of uncertainty. The funny thing is that doesn't necessarily mean in his eyes that stocks are going to underperform. And this is the sea change that I've seen, is that there isn't a natural correlation to bond selling off and that actually creating a headwind given how high yields go for stocks, because really it is being driven by the way Lee kind of artificial intelligence and all of these other kinds of trends.
That was a conversation of the week with Mr. Brazier there. That was really, really sobering, and that's a complete readjustment that you're going to begin to see. And on a microcosm basis, it will be percolation like Credit Suisse marking down global real estate 9%. Multiply that in dimensional basis, John, 20, 30, 40 different ways. I mean, his idea of longer, John, longer is when Tottenham wins the Premier League. That's how we.
That's like
how we put it out there.
In decades, right?
Well, he's a British guy, but what you heard there, folks, bottle it. That was a really important discussion.
He was absolutely fantastic, and in some ways, it speaks to the geopolitical tension at the moment as well.
Yes.
He's talking about central banks that have to push back against fiscal policy that just remains loose. The President of the United States about to make a formal request for $100 billion of resources to help Ukraine and to help Israel from New York City. This is Bloomberg.
world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the U.S.
Nobody covers business like Bloomberg. Context changes everything. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
I know these conflicts can seem far away, and it's natural to ask, why does this matter to America? Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it.
The President of the United States, in a rare address to the nation, laying the groundwork for a formal $100 billion request to provide resources for Ukraine and Israel. Live from New York City this morning. Good morning. Welcome to the program. Your S&P 500 pulling back just a touch all morning, down by 0.16% on the S&P. Yields lower by 6 basis points at 10-year, 4.93. Crude rallying, second week of gains on the cards. We're back in the 90s, Tom. $90.60. WTI up by 1.4%.
We're so focused on the bond market, we haven't talked about this, so let's talk about it here. All of a sudden, we're at the 90 level. I haven't done the technical work, but the question simply is, how do you get to 100, and what does it take? And certainly it's news on the war, which will drive that, and I think we have to watch it over the weekend. I mean, it's not about getting to Monday, it's about getting to Friday evening.
Last year we drained the SPR, and this year they're easing sanctions on Venezuelan crude production. I'm not sure if that gets it done. Remember the Saudi cuts? Let's see the review of those, Tom. I believe they are monthly.
Yeah, well, I'm glad you mentioned this. It was, Oliver Quick mentioning that there's going to be some form of Arab meeting in Cairo. I believe it's today or tomorrow. And, those are the kind of meetings that this gets sorted out, which is the elephant in the room. What will the Saudis do?
Crude was up 6% last week, TK. It's up a little more than 3% so far this week.
We need a briefing right now. Anne-Marie Harden joining us now, our Bloomberg Washington correspondent, as we stagger through Friday and into the weekend. Anne-Marie, I want to play off a CNN poll that was done. I'm sure you've reviewed it, and it's like who's for Palestine, who's for Israel, and all that. There is a single sentence in there that got my attention, and that is, over the last decade, Israel's support of Democrats, I don't know what the right word is, has drifted or slipped or changed away. After the president's speech, discuss his party and their support for him.
Yeah, over the decade, and Gallup did this research, Tom, over the past decade, what we've seen is Democrats become a little bit more critical and skeptical of Israel. And it was this year where actually you do see Democrats within America, their sympathies lie with the Palestinian people. The president has been, over the course of the past nearly 2 weeks, making the case, and this is something he is deeply affected by, about the right for Israel to defend itself and how it is in the national security interests of the United States to make sure they are supporting Israel in their right to defend itself. This is something the president really holds dear since he was a child. He talked about in a number of these speeches the fact that he would bring his children to view concentration camps. This is something that he personally is affected by, and he wanted to make that case to the American people yesterday.
Anne-Marie, what is the task this weekend? I mean, not so much the president, but the administration. Do they speak to the Saudis? Who's the number one phone call to?
Well, I think they're talking to everyone at this moment. What I think the administration has to deal with right now is the present danger to our men and women in Iraq, in Syria, on air bases, where General Pat Ryder yesterday at the Pentagon talked about that they are coming under increased fire. There's a lot more uptick in drone activity, as well as yesterday, the destroyer in the Red Sea intercepted missiles and drones that were likely headed towards Israel from the Houthis. So this is going to be front and center for this administration and the Pentagon as we go into the weekend.
Anne-Marie, you nailed it. The president had a purpose yesterday evening. So let's talk about that purpose, the follow-through, a formal request, $100 billion in resources to help Ukraine, to help Israel, and other issues on the agenda as well. Anne-Marie, how does that happen without a speaker in the House? How's this going to work through the next few days and weeks?
Well, it's a great question, Jonathan. If you ask individuals who actually drafted the language of what a pro temp speaker does post 9/11, this was drafted for continuity of government, they will say that actually the pro temp speaker has the powers in a time to put something on the floor, especially if it has to do with an emergency situation. But the Republican Party, Jonathan, is chaotic right now, and we just don't know how they want to proceed yet. Jim Jordan is saying he's going to go to the floor for a third vote. He's going to be speaking at 8 a.m. Potentially we'll get a little bit of an update from him on whether or not he thinks he has a better chance. Likely it doesn't look like he has those votes. And we're once again Groundhog Day in Washington, D.C., and it's paralysis, really, on the House of Representatives. So it makes the president's request much more difficult, but by and large, you do see bipartisan support when it comes to supporting Israel. The president is casting a wide net here. He's including partners in the Indo-Pacific. He didn't mention China by name last night, but clearly he was talking about China and Taiwan. And also there's going to be money for the southern border. So there's something there for Democrats and Republicans alike. So when there is a speaker, or potentially they give a little bit more of a nudge to Patrick McHenry, the pro temp right now, to potentially put this on the floor, there will be the votes.
And I'm sure President Biden doesn't mind that much from at least a visual perspective that there is disarray in the Republican Party. I am wondering, though, with Jim Jordan, why is he running again if it is very unclear whether he has the votes?
Well, this is an individual who fiercely does not like to lose. It's almost ingrained in him that he does not like to lose. And you know, no one really, I think, at this moment is a clear win for the Republican Party to get to 217. One Republican I heard, Mr. Joyce, say, no one in this party can even agree on the time of the day. So you can see how fractured the party is right now, and potentially Congressman Jordan just thinks, you know, a third time is a charm. Maybe I could jawbone some of these individuals down to see my vision. The issue is this is actually starting to get a little bit of violent in the rhetoric. There's a number of congressmen, Don Bacon, he's come out saying his wife has gotten threatening text messages. I listened to a voicemail that CNN put out that was very disturbing. I mean, incredibly disturbing and chilling of what potentially some of these allies or individuals in Jordan's office are saying to congressmen and women and their families who oppose Jim Jordan. I'm not sure if that bullying is going to work. We'll see today at 10 a.m.
There have been a number of congressmen have come out and said it's actually pushing them in the opposite direction. Anne-Marie, does this make it more or less likely that there'll be some sort of Speaker of the House supported by both parties, a sort of bipartisan type of character?
I think the Republicans are going to exhaust all their measures, and then potentially you're going to see some wheeling and dealing on the Democratic side to get someone in place. Yesterday, we had thought that they were going to really try to expand the powers of Patrick McHenry. But when the Republicans came out of that conference early in the morning, it was very clear the majority of the Republican Party did not want to go on that route. They wanted to make sure that they were able to elect a speaker. At this time, it's really unclear the path forward, but there is that potential that we could see almost a power sharing within the House of Representatives if there's a more moderate centrist Republican that goes for the speakerships and gets Democrat votes. The issue is, in about 1 year's time, that individual will be up for re-election, and the hard right of the Republican Party is going to want to primary that person.
MH, thank you. Anne-Marie down in Washington, D.C. on the latest regarding the president's address to the nation yesterday evening. Tom, $100 billion. And within the $100 billion, you're talking about multiple causes.
Yeah,
the two most prominent ones.
Precisely.
Israel and Ukraine. If you can get the support for Israel and you have that consensus in Washington, do you have the same consensus on Ukraine at the moment, particularly from the Republican side? I don't think you do.
I think it's a
don't think
movable
you do.
feast.
I'm not sure how easy this will be.
This goes to the polling, including the Bloomberg poll of a few days ago, showing Mr. Trump doing better than good in some key states as well. What's after the first 100? 50? Do you do a harmonic spend, or do you go to 200?
Well, but and also just to pair this idea with the fact that there is no Speaker of the House. How political is the timing of this? Yes, they need the aid. They're not going to get it for a long period of time based on some of the dysfunction down in Washington, D.C. So how much is this aimed at pressuring some of the bipartisan members who do support both causes?
Yeah.
And that, to me, is part of what I think we have to understand with the timing, too.
On the fringes of either party, you know, you can get pushback to Ukraine aid from the Republican side. You get pushback to the Israeli aid as well from the Democratic side on the fringe of that party as well. It's really, really difficult right now.
I would suggest the British phrase, they will be overcome by events. Let's try to get to Monday.
We have been, haven't we, over the last couple of weeks, in a big way. From New York City, up next, Deborah Cunningham of Federated Hermes on this market. What a bond market move so far this week. Your yield, 493.50. From New York, this is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We are on the longest daily losing streak in about a month on the S&P 500. 3 days of declines on the Nasdaq. Your price action looks like this. We're down another 0.2%. Let's see if we make it day 4 on the Nasdaq. We're down 0.25%. We have to confront developments in the bond market. 2-year, 10-year, 30-year cycle highs through the week. 493.50 on a 10-year. We're down about 5 basis points on the day. Within a basis point, within just 1 basis point of 5% a little bit earlier on a 10-year maturity, 4.99. Your 30-year, Lisa, even with a 4 basis point move lower, still comfortably above 5% this morning, kind of speaking to the move we've seen higher in yield this week.
We're at levels that we hadn't really gamed out, that were kind of the worst case scenarios. The Bill Dudleys would come out and they would say something like, yeah, yields could get to this point, and everyone would write these, sort of dramatic headlines that everyone would then shrug off and say, that's not plausible. Here we are, and I think the biggest surprise is not that rates have gotten here, but that it's that you have not seen a commensurate sell-off in risk assets to really pair that. That basically this has come with strength and ongoing strength and resilience that no one really imagined.
Data's still good, right?
Exactly.
You guys are dead on here. Torsten Slok moments ago puts out a deck from Apollo, and he says it's simple. The default cycle started. And that's something, Lisa, you've been following here. And the answer is garbage like auto delinquencies and the rest of it has really gotten ugly in the last month or two.
But we're still not going to 2007 levels, 2008 levels.
Are we, though? That's the question in terms of default. I don't know. I really don't know what to do with it. I was walking down the corridor at Marrakesh, and there's Bill Dudley walking at me.
How Bill was that?
Can we stop for a moment and say, sometimes you make the right call, and it's not because you got the reason why. He's genius of the year. I mean, it's amazing what Dudley's done.
I always reflect on a conference that I did for Bloomberg, actually, back in the summer of 2021. I had 2 panelists. One was Bill, the other was Mohammed. And they were both talking about the prospect that maybe inflation isn't transitory. Mohammed was really pushing the idea that there's some real two-way risk here we need to appreciate, and we're not. This could well be the real deal, an inflationary problem that this Fed has to respond to aggressively. Fed's still doing QE. Got to remember the backdrop here. Rates are still 0, Fed's still doing QE. Continue doing QE for like the next 9 months. Ridiculous. And then Bill comes out and he talks about how far Fed funds might have to go.
Yeah.
And he talks up a 5 handle. And I'm sitting there listening, Tom. We're still doing it virtually because it's still post-pandemic. That's how far this is how far back this was.
Yeah.
Sitting there thinking, Bramo, 5%, no chance.
And why not?
Something's going to break.
Exactly. And then you're going to see this rash of defaults that Slok says is coming, but it's just sort of on the margins. It hasn't become an existential risk.
That's the bond market story. Let's get to the commodity market story right now. Crude, Brent, WTI pushing higher through last week, again this week as well, up by 1.4% on the session. $90.60 WTI, Brent crude $93 and about 60 cents. Under surveillance this morning, the US sending more forces to the Middle East, including fighter jets, as tensions flare in the Israel-Hamas war. Minor injuries were reported after US bases in Syria and Iraq were targeted by drones yesterday. A US destroyer also intercepted 3 missiles launched from Houthi militants in Yemen, believed to be headed in the direction of Israel. The risk here, Lisa, I think we all understand it and appreciate it now. The risk is that this becomes a broader conflict and maybe even, perhaps, and we all fear it and hope it doesn't happen, the US gets pulled in.
The frantic diplomacy that we have seen really highlights that. I thought it was interesting that Rishi Sunak met with the Saudi Arabian leaders in a way that the U.S. president could not, because all of those meetings had to be canceled after the explosion at the hospital. This, to me, highlights how concerned everybody is about a broader conflagration, and yet nobody has understood how to put the genie back in the bottle, especially given all the anger.
And if you thought it would deliver some kind of sense of urgency in Washington, the answer to that is no. Congressman Jim Jordan continuing his bid to become the next Speaker of the House. Jordan expecting to hold a news conference at the top of the hour with a 3rd vote set for 10 a.m. A measure to make Congressman Patrick McHenry the temporary Speaker, Tom, has failed.
Yeah, I would watch Mr. Jeffries into the weekend. I think the gentleman from the Democratic Party, he is from New York City, and Mr. Jeffries, Congressman Jeffries, is going to be front and center here. If you go, let's assume it's a debacle, pretty predictable right now. Okay, so it's a debacle. What do you do to get to Monday or the Sunday talk shows? And the answer is listen to the Democrats.
A lot of stories off the radar at the moment. There were really like the story on the radar only a few weeks ago, including this one. General Motors and the United Auto Workers nearing a tentative deal to end the labour strike. Our reporting here at Bloomberg saying the two sides are moving closer, but still having disputes over pay and pensions. UAW President Sean Fain expected to give another one of those updates, Lisa, a little bit later this morning. We'll get there at 10 a.m.
I take your point that it's off the radar. It's sort of interesting that it is, given how long it's gone on and how much this potentially could reduce the supply of cars. And what does that do? Increase prices at a time when people are worried about inflation. To me, this really does highlight how all of these micro factors continue to go on as people worry about sort of these exogenous risks, and are the reasons why people still see strength, ongoing inflation, and some of these other kinds of wage pressures that this really represents.
Clearly, Tom, UAW feels like they've still got leverage, which speaks to that jobless claims number we got yesterday. What was it, sub 200?
Yep.
Yeah,
sub 200 on claims.
Yeah, stunning. It was really stunning. Continuing claims was what I guess they call quiescent. What I want to know is they got to get back to work because they got to compete with the Cybertruck,
which is out in November. Delivered, delivery's coming out.
I think, they got to get back to that. Right now, we are going to give you a terrific brief, as we did before, on this bond debacle. She has lived it. Deborah Cunningham joins us, Global Liquidity Markets CIO at a massive bond house, Federated Hermes, with all of their experience in money market funds. Deborah, I'm not going to mince words. All my radar's up, and my lesson on radar is to go to trust and liquidity. Into the weekend, is there trust in the system? Is there liquidity within the system?
There are both at this point, Tom. I think, as Lisa was mentioning, this economy has a huge mosaic of factors that are inputs to what's happening in the overall market. What the strength in the economy is, what the yield curves are doing, currencies, all of those things. And ultimately, the liquidity markets and liquidity in the broader markets seems to still be resilient and have strength going into the weekend.
Deborah, we were talking earlier in the show, at what point do we reach a tipping point where all of the investors who have just hoarded cash in 5% yielding funds start to say, you know what, we actually are worried about locking in some of the repricing risk on the longer end of the curve. Have you started to see that on the margins?
Lisa, we challenge ourselves with that every single day. Should we get longer? Should we go into other products? Should our advice to clients be going into and locking in some of these longer yields? And we think the beginning of that process has started to occur. Certainly, we've started to see some pickup from a bond flow perspective, but not en masse yet. And I think that's because we finally have a bond market, and we saw the statistics that are 10-year, 30-year, 2-year types of yields that are above or approaching 5%. We finally have a bond market that is reconciled with the fact that the Fed speak out there for the last year, higher for longer, is truthful. It's what's happening. Don't expect something different.
But Deborah, what do you make of the fact that we're not seeing some sort of race toward 10-year, 30-year bonds at 5% yields at a time of great geopolitical concern, at a time where people are looking for haven trades to protect against possible unrest? Does that send a pretty powerful and deeper signal to you?
I think it sends the signal that we're still not sure if inflation is reined in to the point where the Fed is comfortable in maintaining a yield that, is for an extended period of time without going higher. Certainly, Chair Powell and other Fed speak is leaning in that direction. But we don't see, I don't think that what we're seeing from an inflationary perspective is 100% confirming of that. I mean, you were mentioning the auto strikes. That can be, a negative from an inflationary perspective, both from a wage inflation as well as from a vehicle inflation. We don't know how that is going to impact us. You have issues from, the conflict in the Middle East. What does that do from an oil inflationary and an energy perspective? There are so many unknowns out there from an inflationary standpoint that I think people will continue to be tentative until some of the fog in that picture starts to clear.
Deborah, Friday, as you well know, in Federated land means do Frank Fabozzi, the giant of teaching us about fixed income dynamics. Let's do it right now. The conceit into the end of the year is mark to market. We're not mark to market, and we'll just hold it out to maturity. Baloney. It's just baloney. If I've got a 10-year piece, how far out is my break point where things fall apart, where the idea, the conceit of holding it forever falls to pieces?
Well, it really depends on, what the coupon is on that 10-year piece. If it's a 5% coupon that you just bought recently or a 4.5, it's probably not that lengthy of a holding period. If it's something you bought a year or two ago and has, yields that are several hundred basis points below that, you're not breaking even at any point in the near term. I think from a bond investor perspective, it's hard to get off yield. Yield has been what has ruled the roost in bond land forever. But total return is very, very impactful and needs to be considered as well.
Thank you. This is incredibly important. So let's go again to Frank Fabozzi and the idea that we are switching from a yield mindset to a price mindset. How will that affect institutional bond buy side?
I think what you're going to see is resistance to that. But as the resistance starts to fade, you'll see people lumping back in to the bond market, because what the downside risk is with yields above 5% is much less than the downside risks when yields were at 3%. So coupon clipping from that part of the total return should help get you through some of the price risk that you still may experience. All in all, though, you have to have a time frame that's longer than 3 to 6 months. You need to be thinking about something that's more in years for that type of thought process.
Deborah, thank you. Deborah Cunningham there at Federated Hermes. Tom, it takes time to adapt and adjust, to borrow a phrase from a wise man in a bow tie, to what has taken place over the last couple of years.
I can tell you, folks, I went through a couple bond debacles way back that were kid stuff compared to this. You just heard a massive jaded pro there, and the gentleman from BlackRock was Jean Bovin moments ago.
Yeah.
His Bank of England experience. Folks, you're getting a snapshot here. Did you see how Deborah Cunningham was not stammering, but choosing her words carefully?
Locked in.
Because this shift from yield to price is really rare in the last 20 years.
There's one security that I keep bringing up on the Bloomberg terminal, and it matures in 2050. It's a 30-year gilt that was issued in the summer of 2020.
You taught me that, yeah.
It's trading in the 30s. Yeah. Just to get your head around that, it's trading in the 30s. Yeah. It had a coupon, Tom, just looking at the numbers here. 0.625.
We had 2 interviews just in the last 2 hours. Their time frame is when the Tottenham wins the Premier League. That's all there is to it.
Which is probably when that bond matures, Tom, in 2050. If you're just joining us, welcome to the program. Hello, Daniel Levy. Your equity market negative by 0.3%.
Somebody tweeted out today, let's try to take a moment here of joy. They went back and looked at our Christian Horner interview.
Oh, right.
And they're in Austin.
What made them do that?
I don't know. They're in Austin this weekend.
They are, yeah. I saw that.
Explain to our American audience here.
Well, maybe you can. You're the big fan now.
No, I don't have a clue, but it's the same. It's a track you don't like. You don't like these modern Miami.
I don't like the newer tracks. I don't like Miami. I'll sort of remain on. I'll work out what I think about Vegas, all right? I'm trying to bite my tongue a little bit here. I don't like any of it. I really don't. I like the traditional tracks with a lot of heritage. I prefer that.
Yeah.
So I like sort of your Monacos, Hungary, Spa, Belgium, Monza, Italy, Silverstone, of course, in the UK. That's my preference.
That's about
reserve judgment.
It's all about all the light chat we can have. The events here this week have been exhausting. We've got to go right back to the bond market and yen at 150 and the rest of it.
Which almost makes you need a vacation to some of those places, which sounds like a better vacation than some other places.
Wouldn't that be amazing? Jerry Halliwell does that now, right?
Goes around
because she's married to Christian Horner, so just goes around to do the
tour.
If I won the lottery, without doubt, I would do the tour. That would be me for the year.
Your co-host with you, so we could do the show there.
No, I'd retire, phone in, see what you're up to, that kind of thing. From Monaco, that'd work. Like that. Then all of a sudden,
are you going to Vegas?
I'd love these.
Are you going to Vegas?
How many lotto tickets have you bought recently?
I don't gamble, Brammer. I'm not a gambler. No gambling for me.
But if you did.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
When America experienced the hell of 9/11, we felt enraged as well. While we sought and got justice, we made mistakes. So I caution the government of Israel not to be blinded by rage.
Not the first time we've heard that from this president this week. President Joe Biden, in an address to the nation, trying to find a bit of balance there with those comments. From New York City, welcome to the program. On the S&P 500, pulling back by 0.25%. Yields lower by 4 basis points, 494.35 on a 10-year. Crude rallying all week, up for a second consecutive week, up by 1.4% and back in the 90s. On WTI, Tom, $90.60.
And the oil lifting up here. It'll be interesting to see off news flow where we'll be. And I'm not, after talking to Oliver Crook, John, I'm not really sure I understand the news flow into the weekend in Israel. I think it is completely unknown.
I keep going back to something I've said, Tom, a few times this week. Yeah. Going into last weekend, seemingly on the brink of a full ground invasion. Feels like something's changed in the last few days.
Something's changed. I agree. Lisa,
had this week of very intense diplomacy, Bramo, and we've had leader after leader visiting Israel. And it just feels like that timeline's been pushed out somewhat.
And there's a question around what the objectives are and a greater focus on what things will look like in Gaza after this whole explosion of tensions really ends. There's also an issue of how much we are dragging other regions into the conflict and how that's becoming a real issue and a real threat.
We're going to begin now with a really delicate conversation with the gentlelady from Michigan. Haley Stevens is a Democrat from Michigan. Of course, it's a Michigan of Dingle, Debbie Dingle, and the rest. But it's also a Michigan that shows the immigrant demographic and makeup of America. Haley, good morning. Thank you so much for being with us. As you know, the Arab community coming off of 1947, 1948 in Michigan is Dearborn, Michigan. You don't represent that, but you've got to live with a heterogeneous Michigan right now. What is the support for the president in a fractious Michigan?
Well, I would be able to tell you more if I wasn't trapped in Washington waiting to vote for a speaker. But look, I think people are heartbroken about what has taken place in the Middle East. They are heartbroken over the terrorist attack on Israel. Certainly, our Muslim community is feeling, as the president said, the unfortunate reminders of what took place, the targeted violence that took place towards their community in the wake of 9/11. And this is a moment, just as our president did last night, to show compassion, to really talk about who we are as Americans, that we are a welcoming place of diversity, and we do celebrate our Jewish community in Michigan, who is hurting right now, and tell them to be proud of who they are, and we celebrate and recognize our Arab and Muslim community in Michigan and tell them to be proud of who they are. All are welcome in this country.
The shift here, Haley, in Michigan is a perfect crucible for this. It's from John Dingell and Debbie Dingell in a support of the Democratic Party for Israel, which, as our Anne-Marie Horton says, has ebbed away. And that tension outside Detroit is an image, a small piece of the American debate right now. How will you represent that debate in the House if and when you finally get a House that's organized?
Well, I've been very clear about standing by democracy, and what we heard from the president last night, needing to support Ukraine, needing to support Israel. Certainly Armenia is on our minds as well, with autocratic attacks coming from Azerbaijan. I sit on the Select Committee on Competitiveness with the Chinese Communist Party. It is very clear to me that this marker in time is about democracy versus autocracy. I am not calling for war, but I am saying that free markets, capital markets, and open democratic societies need to continue to lead the free world. And if we do not stand by our allies, if we do not stand by the only democracy in the Middle East and find a path to peace, that is where we need to go. And that is where I'm going to vote, that is where I'm going to support, and I am going to continue to be there at the same time for all of my constituents. I have been very clear about my views on supporting democracy, on supporting Israel, as well as Ukraine at this time.
Do you think that your fellow Congresswoman from Michigan, Rashida Tlaib, is showing that compassion and helping the cause?
I'm not here to talk about any of my other colleagues. You're asking me about my position and where I plan to vote as a member of Congress. Our Michigan delegation is small, it is mighty, and we work together on a multitude of issues. I don't agree with all of my colleagues on their issues, but I will say that I am planning to support the president's call for support for Ukraine and support for Israel. I was just in Israel in August. I was at Kfar Aza. I was looking out on the Gaza Strip. I was hearing about how 20,000 people come in daily to work in Israel, how all people want is peace, and we do need to find those pathways. We've got a modern president in Joe Biden with a vision for the future and a vision for a path to supporting our allies in finding peace, and that is where I'm going to be focused.
A lot of people are wondering how quickly Congress can act because of some of the dysfunction, the fact that there isn't a speaker right now. A question of whether Patrick McHenry could potentially get bipartisan votes to be at the helm. Would you vote for Patrick McHenry?
I am going to vote along the lines of how we get out of this in a bipartisan way. Right now, I'm on the Problem Solvers Caucus. You know, certainly our discussions are private at this time. I think empowering as Hakeem Jeffries put forward yesterday, and we thought that the Republicans were with us, a temporary speaker pro tem to get us out of this mess. I will say the day that Kevin McCarthy resigned as speaker, I said that we might be in a national security crisis, and this is a threat to our country. And then on Saturday, we woke up to the devastating news of the terrorist attack on Israel. We are feeling the tensions back at home. We are feeling the worry. The House cannot be shut down. We're in over 2 weeks of this mess right now. I want to get out of it. We cannot see our government shut down. The funding has got a deadline less than a month from now. That would obviously be catastrophic. So whatever it takes. Mr. Jordan appears stubborn and intent on moving forward when he clearly doesn't have the support, bipartisan support, or the support that he needs within his caucus. And what we've seen this entire term, this has been going on since way earlier than Kevin McCarthy's being pushed out as Speaker. Republicans are not in agreement with each other. Republicans are blocking Republicans from passing Republican legislation. We are in shared government. We've got a Democrat as President of the United States who's known for being bipartisan. We've got a small majority in the Senate. We've got Chuck Schumer who's doing the work. we got to get our acts together. The adults need to lead right now.
This sounds like a campaign pitch. Congresswoman, how are you going to work in a bipartisan manner if you're unwilling to address the division in your own party?
I don't know about what division you're talking
Well,
about.
let me highlight it right now. I'll give you the quote. Rashida Tlaib, Israel just bombed the Baptist hospital, killing 500 Palestinians just like that. Tweet's still up. Can read it. It's different to what you think, isn't it?
So we're talking about the speaker, and we're talking about 212 people are voting for Hakeem
You're
Jeffries,
talking about
and
that, not what I'm talking about. I just referenced the quote. You said you're willing to address the division in your party. Let's do it right now. Why is that tweet still up?
That is one voice. I do not control another member of Congress. I have been very clear about where I stand. We can see the votes time and time again. 400 plus members in this very body voting to support Israel, voting to support the Iron Dome. Those are my positions. I could sit here and try and argue with Jim Jordan, argue with Matt Gaetz, argue with the people who have different viewpoints that represent a very small minority. Look, the intelligence is out there about what happened with the hospital. I'm listening to Israel. I'm listening to the U.S.
And
intelligence.
your Democratic
and
colleague
so is my Democratic leader, my
your
friend.
Democratic
so
colleague
is my Democratic
isn't
leader.
listening to it. Based on that, she isn't. And you've got nothing to say about it, which is pretty amazing.
I just said my position, sir. I just
Have you
said,
spoken to your Democratic colleague?
we have all spoken, and our leadership has spoken, and our president spoke last night. I really don't understand what we're debating here.
Haley Stevens, thanks for being with us. Congresswoman from Michigan. TK.
This is the debate, and to the congresswoman's credit, there is a tradition that you don't criticize other congresspeople. That is an ironclad agreement across a party that goes back well in excess of 200 years. With that said, it is Michigan is a crucible of these demographics.
Like from New York City, your equity market is slightly negative. We're down 0.1% on the S&P 500. From New York, this is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
People are looking for safety alternatives.
To me, look, bonds now yield something. They offer real value.
The further that yields rise, the greater the chance that a slowdown is going to be even deeper.
Consumer spending is starting to soften, but it's not broad enough yet that it's falling off a cliff.
We could keep up a sustainable pace that looks a lot like, if not a little better, than where we were before the pandemic.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. An exhausting week, an extraordinary Friday. We welcome all of you on economics, finance, investment, on international relations in a fractured Eastern Mediterranean. Lisa, we're all exhausted. I think we've got to start with the bond market. It's been a huge theme through the morning. It's just simple. Yields stay up, sustained, and prices down.
Somehow the idea of post-2007 highs has lost its power. It's lost its punch. We've gotten sort of benumbed to this idea of this immeasurable climb higher. The question now is, how high can it go? Do we basically have this sudden skepticism that we can get back to anything close to what we used to know? This idea that, yes, you can leg into longer-term bonds because at some point you'll like the idea of 5%
The question to do with your diminished wealth, if you're not in the triple leveraged all cash fund, we've got an important guest coming up here on multi-asset translated linkage between equities and bonds right now. I want to get to the international in a minute, but we've been completely devoid this morning, Lisa, on the equity markets, and there's American Express is some form of clarion signal that no one's paying attention to.
Record revenues. We're talking about record profits, people coming and paying for the luxury of whether it's going to a Sky Club or whether it's the other perks that American Express offers. But what this highlights is just, again, that the well-heeled individuals are not hurting. And you can see that again and again. American Express shares not doing much in pre-market trading. But these numbers are really stunning, given how much you already had baked into these shares. Third quarter earnings per share, $3.30 versus the estimate of $2.95.
That's a simple look back. I'm going to look forward and say double-digit plan there of, well, double-digit. I'm overdoing it. 10% was a modeled plan, but 7% core growth. And these are numbers that come from a sprightly economy. And that's, again, within this horrific bond news flow, the horrific news that we see out of the Eastern Mediterranean. I'm sorry, the American GDP statistic is solid.
Here's where things get really kind of rather confusing, especially in the perma-crisis world that Mohammed El-Erian and others have written about. People are expecting defaults to pick up. Suddenly, the whole world collapses. You're seeing, actually, the bad loan charge-offs in American Express increasing, going beyond what people previously expected. They're just making so much money on the other side that they offset that. And this highlights where we are. Yes, there are people struggling. There are people not paying their bills. There are companies that are defaulting. But that is not torpedoing the broader economy in the way that it has traditionally, at least in the 2007-2008 cycle.
To channel Batman's friend Marty Fritzen, holy Marty Fritzen, and the answer is the default season is clicked in here. Torsten Slok at Apollo out with a deck this morning. We're not going to quote it now. We got to get out. My bow tie. I can't do anything with my bow tie today. On radio, it looks terrible. And the answer is Slok. A default cycle has started. Bramo, discuss.
Well, it has started, but how far will it go? He writes, a default market has started with bankruptcy filings rising, and default rates will continue to rise over the coming quarters, impacting, in particular, middle market companies. This goes to something you've talked about extensively, Tom. How much does the lower tier of players, whether it's smaller businesses or whether it's less wealthy households, are going to have a completely different reality than the rest of America? And how much do we see that divergence widen out?
Lots of narratives away from the market and away from the Eastern Mediterranean. And Mr. Jordan of Ohio is speaking right now with flags assembled behind him, and it's very simple. This is, Lisa, help me here, because I can't keep count. I'm not like Horton. Horton just memorizes his stuff.
It's his third
vote today?
Yes, it's his third vote, and he said that originally he waffled. He said he'd throw his support behind Patrick McHenry, and then he's not going to give up. This amid a lot of controversy and accusations of threatening voicemails and texts to the other Republican Congress members.
Joe Matthew and Amory Horton following this, I'm sure, a terrific sum tonight on a 3-hour version of Balance of Power. I think that's
I'm
what
sure
they're
they'll be
going
very happy that
to
you just
do.
assigned
We're
them
going to tackle the data check right now. Oil elevated off of, I'm going to be certain, missile strikes from Yemen, moving some vicinity north towards Israel or other points. I got Brent crude was giving me some 94 love. The answer is we've come back to a 93 handle, 93.43. Bond market. It's real simple. I'll just say this, Lisa. The real yield is where I never imagined it. I had a 250 walking in the door this morning. It's 247 right now. I have never framed a 247 modern 10-year real yield.
I am so glad you brought this up. This is the inflation-adjusted yield, and this speaks to what Jay Powell said yesterday with our own David Weston when he came out and said, what's driving longer-term yields for higher? He didn't really give you any kind of conclusive answer, but he did say it doesn't seem to be driven by rising inflation expectations. It is risen by something else, rising deficits, rising uncertainty about the demand bid at a time when you have places in Japan and China pulling back.
Global Wall Street watches us, listens to us for the things below the narrative. Here's a tea leaf. Credit Suisse, and no, it's not the UBS rationalizations and layoffs. The major fund, real estate fund of Credit Suisse has dropped. They've repriced it negative. I don't think it drops. I made that. It's my fault, folks. Not accurate. They've repriced it. It's like a Tesla price cut, down 9%.
Prices lower, yet not necessarily forced selling, and that I think is going to be the key. When do we see forced selling and realization of the losses at a time when people are seeing sort of paper losses mount?
The tension here, the VIX 20.91. With experience and a wonderful clarity of note at Neuberger Berman, Eric Knudsen joins this morning. Multi-asset class CIO. That means he's been there longer than 10 years, and he joins us again amid this tumult. What does the bond debacle mean, Eric, for stocks?
Well, good morning, and it's always a pleasure to join you, especially when I'm being followed by a quote of both Batman and Torsten's Lock in the same sentence. So, I mean, I think first and foremost, this is a time for humility in multi-asset investing, and there is such a divergence between short-term economic information, including earnings, which are coming in quite, nicely. Short-term GDP growth expectations, unemployment, consumer behavior, as you said, as reflected in the Amex earnings, with much higher interest rates, much higher, stickier inflation, and the crises around the world and in Washington, et cetera. And what this highlights is a time where we don't want to make big beta bets in terms of big market exposure moves, but we want to be what we call long the strong, focused on quality within equities, within fixed income, in private markets, real estate, where there are some now interesting opportunities as real estate gets repriced, as you see. And that's where we're seeing interesting opportunities right now.
Eric, there was an interesting question raised earlier this week about how much of these repriced assets are actually for sale. When you go out and you try to buy things at a discount, can you find them?
There's still, a pretty good-sized bid-ask gap in private markets when you're looking to engage in this activity. That said, the pricing where markets are clearing when things sell are becoming more and more interesting. Average secondary pricing in private equity markets is 90 cents on the dollar. Real estate even more attractive, and And, for our clients who can lock up capital in longer term investments, we think the ability to provide liquidity right now, whether it's in private credit or secondaries, where you can solve problems for distressed investors, not distressed assets, is one of the interesting opportunities right now in this quite, confusing overall environment.
This is an interesting trend that I've heard a lot about. Basically, the new distressed debt bet is not to wait for a company files for bankruptcy. It's to go to the CFO and say, you got to refinance in 2 years, and you're going to have a problem on your hand if rates are at this level. So let's figure out how to extend your maturities, add some certain protections, and you can give us secured assets and change around some of the structures. How much is that extending this cycle far beyond what people expected in terms of the effects of monetary policy?
It's one of the aspects. As banks and traditional providers of liquidity have pulled back, and you've seen the slews and other information indicating that bank standards are tightening, lending activity is down. A lot of that is moving to the private markets, where private markets investors don't have to mark to market on as regularly. They can take longer term time horizons, and there's a lot of additional capital that can help kind of buffer some of these impacts. I think the other thing that's going on is if you give corporate management a year to prepare for the most predicted recession, they can actually mitigate a fair amount of the impact of the impending recession. Earnings were down 6 to 7% for the S&P 500 in the first half of this year. Normally, when you see the kind of decline of growth we've seen from last year, from a year and a half ago to this year, that would have been down 10, 15, 20%. And now you're seeing earnings kind of surprisingly, or perhaps not, bouncing in the short term. Our focus is on companies that can weather an environment of slowing economic growth, sticky inflation, and higher interest rates.
Eric, is that big tech? And right now, with the load the boat on big tech, PEs of 20, 30, 40, 50, whatever the number is, what we're doing is we're betting out our comfort out 2 years, 3 years, 5 years. Are we going to get run over doing that?
Well, I think certainly some of the Magnificent Seven, the big cap tech names that have been leading the market, are certainly fully valued. That said, those companies are extraordinary. Most of them are extraordinary in terms of the quality of their operations, the amount of cash they have, their debt levels, which are low and have been termed out. They're actually experiencing an improvement in financial conditions as interest rates rise. So we don't want to ignore those companies, but we need to be sensitive to valuation. Where we're trying to, where we see opportunity is down the cap spectrum, but away from kind of the broad index exposures, say in the Russell 2000, which is a pretty junky benchmark, and finding high quality companies. And the same is true on the fixed income side, where we now like bonds in the 2 to 7 year maturity range, from treasuries to corporates to asset backs.
Eric, this has been a great brief. Thank you so much. Eric Henderson, with years of experience at Neuberger Berman, enjoying this bond debacle. On that note, 2's10 spread. Look at that, Lisa. I did not see this number all morning. It was buried. The 2's10 spread, are we beginning to talk about disinversion completely? OMG.
You're starting to see it in the 5 to 30 year and the 5 to 10 year kind of spread. This sort of disinversion is not what people wanted to see in terms of the predicate to some sort of economic success.
S&P futures -11, down 0.2%.
Coming up, as we parse through how much to focus internationally versus domestically, I think that's been one of the biggest challenges, Tom, that we've been dealing with all week. How do you parse the human tragedy going on in the Middle East with domestic strength? How do you pair ideas of people looking at what the tea leaves are at a time where there suddenly are even bigger tail risks on either side?
Well, the tail risks were evident last night with a missile attack from Yemen. We talked about that earlier, but to the point of, folks just getting through the day, or far more importantly, getting to Monday, we've got the humanitarian discussion in place. The diplomatic discussion, I think, is in place. We don't have the military discussion in place. That is, and Oliver Crook, I thought, was quite good on this from Tel Aviv. That is the mystery in his Tel Aviv on a Friday afternoon.
And the other mystery, at least for people in the market right now, is oil and where prices go, especially in light of this tension around Iran's fingerprints, and yet no direct accusations, and how much that's really behind the scenes, what could boil over in a more material way.
A hallmark statistic, and Jonathan Farrow's been out front on this, and this is the idea I'm saying, folks, is look beyond the great financial crisis. The United Kingdom 30-year gilt pricing out right now back to a summer of 1998. That is absolutely extraordinary. The yield the highest in London since 1998. Coming up, a piercing essay in the Telegraph in London. Former Ambassador to the United Nations, John Bolton, on the Eastern Mediterranean.
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Send to Congress an urgent budget request to fund America's national security needs, to support our critical partners, including Israel and Ukraine, is a smart investment that's going to pay dividends for American security for generations.
From another generation, perhaps, the President of the United States. Speaking to the nation last evening, we advanced that discussion this morning. Lisa, I thought the conversation with Stevens of Michigan was extraordinary. She is of the President's party, and the balances of a fractious Democratic Party was evident, to say the least.
Both parties are very fractured right now. It raises a question of how much the U.S. has the capacity to get people to agree on some of these key measures that the President was trying to get people to coalesce around last night. And that, I think, is one of the main challenges that he's dealing with, both within his party as well as within the Republican Party.
Anne-Marie Anne-Marie Horton, folks, of Balance of Power, sending me a survey, I believe from Pew or Gallup. I can't remember, to be honest. I'm so sorry. But it really shows the tilt here in the nation, not so much towards a Palestinian temperament, but away from the certitude of an Israeli mood.
It was a Gallup poll, and basically saying that the net sympathy for Israel had gone below 50% among Democrats, and this is sort of what the tension is underpinning some of these debates.
We thank Congresswoman Stevens for a tense interview. Right now, always tense, is Greg Valliere, our chief U.S. policy strategist at AGF Investments. His note in the mornings early is a must-read. Greg, it's not a layup in a fractured Congress. We just heard the gentleman from Ohio speak moments ago. We heard some of the tensions there from the Democrat Stevens of Michigan as well. What will be the process to deliver $100 billion to 3 or 4 projects?
It could take a while, Tom. I mean, I think the case for aid to Israel and Ukraine is self-evident. But apparently that's not a view shared by a lot of people on Capitol Hill. The problem is things are so dysfunctional in the House. Without a House Speaker, it could take weeks before Israel and Ukraine get more assistance. And I think the signal that we'll be sending to our allies and our adversaries is not a very good one.
Howard Baker could get together with Tip O'Neill, just as one example. Is there any ability to get the center tendency to meet in the middle aisle?
I think eventually that will happen. Eventually the center will hold. Mitch McConnell will play a role in this. There are plenty of people in both parties who feel strongly we've got to spend more money on both of these horrible conflicts, but it's going to get dragged out. The next deadline that I look at is November 17th. That's when we got to get a budget. And if they don't get a budget, they're going to have to do another extension, probably past Christmas into late winter. If we have to wait that long for aid to Israel, that's very troubling, in my opinion.
Greg, we're talking about a new level of dysfunction, as some people have pointed out. Anne Marie was talking about some of the threats that have gotten actually violent to some of the center tendency Republicans who are not voting for Jim Jordan. Is there a precedent for this type of thing?
Well, during the Civil War, there have been very emotional periods in the country's history, Vietnam War, but this is an embarrassment. What's going on in the House is cringe-inducing to see this kind of dysfunction, and I think that, again, our foreign allies and adversaries have to be looking at the U.S. thinking that we're starting to go off the rails.
How much do you think that this is actually one of the drumbeats that has led up to multiple nodes of conflict that are permeating in many places around the world? This idea that there's increasing fracture around the governments, and I'm thinking in the U.S., I'm thinking in Israel, with the Prime Minister being incredibly controversial. I'm thinking about in other places as well.
Yeah, I think that it makes a lot of countries around the world less inclined to wholeheartedly support us, thinking how dependable is the U.S.? Is what we're seeing in the House going to be standard behavior? Again, I think we're going down a very risky path.
Right now, we're actually anticipating something from a meeting between the European Commission and the European Union presidents, as well as President Biden today. How closely are you watching that to understand just how close this connection is, even with some of the disagreements over trade and steel?
I think they'll say all the expected things. I think they'll try to paper over their differences, but I think privately there's going to be a real candor saying the U.S. has to be concerned about the way that we're perceived right now.
Greg Villiers, we have John Bolton coming up, always controversial. Yep. He's been a magnet for debate and controversy in America. And in an essay here, he really centers away from the trauma of Gaza, the immediacy of Gaza, towards a triangulation of Gaza, West Bank, and the northern border of Israel, and alludes to Iran's ring of fire.
Yep.
What is the debate in Washington over what to do about Iran? I don't observe one.
I think it started last weekend. The Wall Street Journal's weekend publication, which is great, it's a must-read, talked about the need for regime change in Iran. You're starting to hear people talk about that. That's very risky. But I think there's a growing feeling that the Iranians are the provocateurs to a certain extent for Hezbollah and for Hamas.
Greg, that didn't work out in Baghdad a few decades ago.
Yep.
I mean, it seems like yesterday for you and me, but we don't prosecute regime change very well, do we?
No, but it's perhaps a lesson not learned. In fact, I would guarantee you, Tom, that in your interview with Bolton, if you ask him about the possibility or the need for regime change, he will advocate it.
I mean, Lisa, to me, this is just absolutely extraordinary. And it's what Ambassador Bolton's doing, whatever anyone's politics is trying to get beyond the shock of the immediacy of Gaza. And that is, what do we reformulate with Iran 3 months from now, 6 months from now, 5 years from now?
Regime change is a bit dramatic at a time when a lot of people are wondering just where the actual people stand. A lot of people have been protesting the Iranian administration. I am curious, though, Greg, from your vantage point, how much oil plays into this and the unwillingness of the U.S. to really go after Iran. We were speaking with Dan Tenenbaum earlier this morning, and he said that's a key measure. It's a key reason why the U.S. hasn't taken a harder line. Is that your view as well?
I think that's a factor. I think another big factor, Lisa, is how fragile support is if the U.S. got even more involved with naval cruisers and a lot more weapons for Israel. I think a lot of U.S. voters, especially young people, are lukewarm at best toward getting involved in this.
So how much did President Biden's speech last night hearken to a different time and speak to a different audience than the mainstream that will be voting in the upcoming election?
You know, Lisa, I just kept thinking one thing. Lyndon Johnson, back in the late 60s, who made a case to confront Vietnam, North Vietnam. It didn't succeed. He failed politically. And we've got another big primary only about a year away, maybe 14 months away, up in New Hampshire. I think if Robert Kennedy does well, if Joe Biden doesn't do well, there's going to be speculation that the war is an albatross for the Democrats and might warrant a look at whether Biden should stay on the ticket.
Greg Valliere, thank you so much for the AGF investments. My head is spinning. There's just no other way to put it. I mean, what we have seen in the last 2 weeks dovetailed into the financial markets, which I'm going to suggest were already challenged before these military events, these tragic events. It's just amazing on this Friday to wonder where we'll be. I mean, get me to Monday, or how about a week from Friday? Get me to the jobs report on early November.
Bear with me, because I'm thinking in real time, but it seems like we've seen a number of examples of how there has been sea changes in the status quo that we used to understand. U.S. Treasuries as a haven asset this week. That has been something that seems to have been challenged. This idea as the Democratic Party as being stalwart Israel supporters, we've seen that challenged. We've also seen the idea of just some sort of global unity at a time of incredible fractiousness, both internationally as well as domestically. There are all of these basic tenets that are being challenged on a regular basis that were really brought to the fore this week, which is the reason why it's been a particularly confusing soup.
What we have here on the Bloomberg terminal is the market adjustment of this, the market action. Futures deteriorating actually in the last number of minutes. S&P futures down at 20. We have dollar strength, as you would expect, moments away from a 150 Japanese yen, sort of a Pacific Rim measurement there. And I'm sorry, the 2's10 spread, massive disinversion over the week. We are only 17 basis points away from the 2's and the 10's having the same yield. Mirror Pendant, JP Morgan, we do that next.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
how do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything.
Bloomberg surveillance, Lisa Bramwitz and Tom King. John Farrell on assignment. He's getting ready for Austin, Formula One.
Yeah, is that where he's going? I think he's going somewhere else.
He's got the survey. I know he has the Gulfstream this weekend, so maybe he's going to pop down to Austin. We will see. John Farrell in the 9 o'clock hour. Did I hear a rumor that the gentleman from Cambridge will be with John?
Yeah, Mohamed El-Arian, and maybe,
good to see.
I got to say, on his trip around the world, he's going to struggle to really borrow to finance it. How do you like that segue?
That's
very good. Right now, I just want to say that we are seeing 30-year Treasury yields climb to the highest levels, new post-2007 highs.
U.S. Treasury.
Yeah, but elsewhere as well. UK 30-year bond yields to the highest since 1998.
Right. We're back to 07, and I don't know if it's August 07, third week of August, before or after. I'm going to guess it's on that spot. Good morning, David Malpass and the late Alan Meltzer. Or back to 98, Lisa, which August of 1998 was sport, is how I would...
In the United Kingdom.
Well.
Either way, this is really the theme and the drumbeat that we see in markets.
Tape.
Deteriorating tape as people assess both the chance for more borrowing as well as a strong U.S. economy.
There we are. It's interesting to say the least. We're going to continue here on what you need to do to think Friday into this great bond debacle. But first, Lisa, you demand, you're pounding the Bramo table saying, Herman, get Herman.
Actually, I kind of was. Part of this whole thing, we made this big deal about big bank earnings, and we always do. But this particular earnings season, it's the smaller banks that matter arguably more. And we do get a slew of earnings today. Herman Chan, following them all, senior U.S. regional banks analyst at Bloomberg Intelligence. I just want to start there. We've gotten a slew of bank earnings. We got Comerica, Regions, Huntington. After the bell, we hear from one of the more troubled of the banks, Western Alliance. What are we learning?
It's a mixed picture across the board. There is some optimism that maybe net interest margins have bottomed or will bottom in the fourth quarter. So that's positive as interest rates stabilize, at least on the short end. On the other hand, the banks are still feeling the fallout of higher interest rates and the repercussions of March and April. So repercussions meaning tougher regulations, that is driving less lending across the regional bank space. So you're seeing loan growth decline. You're seeing deposits actually stabilize, which is great to see, but they're paying up for those deposits to stabilize the funding base.
There's a real existential question here that John's been good about highlighting, which is Bank of America truly the Bank of America? Or is this the bank of higher wealth individuals and better capitalized companies to immunize potential risk?
Right.
The banks of America, are they showing the stress that we're hearing about in the Beige Book?
It's interesting because asset quality has been fairly stable. You're seeing some weakness in areas like commercial real estate, and that's starting to pop up, but nothing to really drive loan losses at this point. So that's going to be more of a story for next year and the year after.
That's right where I wanted to go. I've got the S&P Regional Bank Index, the KRE, down 48% from a spiky peak. On a moving average basis, it's almost back to COVID lows. And the question off of Credit Suisse, another regional bank, today, marking down their real estate portfolio 9%. How do these people actually mark down a busted office complex in Topeka?
Right. So there's not a lot of price discovery, as what your
Exactly.
question's alluding to. So that's something that the banks are still trying to work through. What they're doing is they're increasing their allowance for the office and other areas that are tougher to sort of figure out at this point. So we're talking about an 8-9% reserve against these office commercial real estate projects. So that's actually a pretty healthy number compared to, and then underwriting's been fairly conservative. So it does seem like the banks are protected against potential losses, but there is still a lot of uncertainty.
The stock chart doesn't look like that. I'm
Right.
sorry. Herman Chan, thank you for the brief this morning. Somehow I think we'll be speaking with Mr. Chan here in the coming months. You know, I'm in triple leveraged all cash. It's just really, really worked out over the last couple. You know, I got a 2-20 payout going, and, you know, I'm the only one. It's brutal.
Well, it's brutal for some people. However, at the same time, there has been strength underlying a lot of this. The fact that we're talking about weakness in the shares of some of these banks, yet resilience in deposits and other issues underscores the challenge right now to understand the bond market moves. And, you know, Mira Pandit over at JP Morgan Asset Management has been covering this, has been discussing this, has been trying to understand the relationship, the new relationship between bonds and stocks. What do you make of the relative resilience in equities this week? It's the moves that we're seeing in bond yields and the weakening that we're seeing around the margins, as Herman was just talking about.
Clearly, 5% yields are a bit of a ceiling for the equity market. We've been waiting to find exactly what that ceiling seems to be, and I think that's where we are with 5% rates. But the challenge is not necessarily where yields are, because growth is still so strong. I mean, 18 months ago, 2 years ago, if I told you in the fall of 2023, policy rates will be above 5%, but economic growth will be tracking above 5%, we wouldn't know what to make of it. And so if you link that stronger economic activity with earnings, and earnings being well supported by that, then what you're seeing is some well-supported equity markets for now. The challenge is, as we look forward to next year with 12% earnings growth expected, that's pretty lofty. Maybe we'll see something closer to 6 or 7%. But if the U.S. economy slows, if some of these headwinds that are challenging consumers continue to materialize, that's going to challenge some of those expectations for profits, and that in and of itself could be a bigger challenge for the equity markets going forward.
Are you getting any clarity from the companies that are reporting earnings? Are you getting the sense that they have a vision forward of what their corporate outlooks are going to be next year?
It's mixed. On the one hand, it's been great to forecast a recession for 18 months because it means that companies have had 18 months to prepare from an expense, from a headcount standpoint, to really bolster where they're getting their revenue and really assess their consumer segments. On the other hand, look, we don't know necessarily how next year is going to play out, and I think the bank earnings were very telling. Usually what you'll hear from financial companies is, here's how we're thinking about recession risk. But instead, what we really heard was, here's how we're thinking about the big, meaty, existential macro risks, from geopolitics to federal finances. So it was very interesting to hear them a little bit less focused on what does 2024 do, as opposed to what is the era that we are entering.
What are your clients, high net worth, institutions, people with a pot of gold, how are they responding to these bond losses? Are they going to cash? Are they running? Were they buying doubloons? What are they doing?
It's been really challenging to have multiple down years for the bond market. And
3 years down plus is on the Bloomberg Total Return Index.
Absolutely, and I think that people need to reconsider their fixed income allocations.
What are they doing? I want to know on a Friday morning, are they, you know, the calls you're having, they're swearing at Bob Michael, et cetera, et cetera. What are they actually doing with these bond losses? Writing them out?
Essentially some of that, but I think that a lot of our clients were not positioned heavily in long duration yet. I think a lot of people were waiting for the entry point, deploying selectively. So there's still very much a barbell within fixed income allocations where you still see a lot of short duration. I think people feel okay about the equity market given how well it's done. But in terms of diversification, you're definitely seeing people asking a lot more questions about alternatives and where to supplement some of these outcomes.
How far out is long duration? I mean, you say short duration. I have no idea what, is that 5 years, 7? Is that the belly of the curve? I mean, where is short duration besides LIBOR 3 months?
I think people have been thinking more around the 2 year, maybe 2-3 years, and intermediate is really 5 to 7. People have not really been thinking much about beyond that for the time being.
But we love we're guilty. You and I, you're the worst.
I'm off.
We're guilty of this because we're quoting a 30-year bond. We're all
and nobody's buying it.
Nobody owns it.
Exactly. Which is like quoting the 100-year Austria piece. Mira, you know, you raised a great point where you said it's telling that some of these corporate executives are coming on and they're talking about macro risks rather than we're a little concerned that we might see a bit of a softer demand in this particular particular sector of our business, which raises the question, do they just see dynamism as far as the eye can see and they don't necessarily want to get ahead of their skis? Is there kind of a binary outcome where you get bonds underperforming and stocks outperforming? You either have that or you have stocks underperforming and bonds outperforming, and it's one or the other, based on the idea that the only thing that could drive bond yields lower is a true full-blown recession that nobody is looking for right now.
Yeah, I mean, it does seem like a very much a binary outcome at this point, which from an investor standpoint is helpful from how we construct portfolios, thinking about being diversified between stocks and bonds and sort of that yin and yang in terms of how they typically operate. So as much as people are saying diversification is falling apart, I do think the bigger driver of that was we had an inflation spike, we had all of these Fed hikes. As the Fed is very much moving from power to finesse on the rate hiking cycle and really getting towards the finish line, that dynamic is going to be less prevalent in the new year, but it will be a bit of a tug of war. And that's what we're seeing now. Challenge in the bond market, success in the equity market relatively.
How much is the new hedge oil? And I ask this at a time of great geopolitical uncertainty and conflict. There is this feeling that whatever happens, oil prices and oil equities seem to be the big winner of this year. Are you leaning into that?
We are leaning into the energy side of that trade. Certainly what we're seeing from a profit standpoint is that is helping energy companies, and ultimately there are some structural underpinnings of this in terms of underinvestment in terms of some of the capex and the supply factors that we're seeing within the energy space within the U.S. and globally. And I think if we look more broadly as well, I point to one thing Chair Powell mentioned yesterday, which was, are we headed for an era of more supply shocks? Is this kind of the pandemic aftershock that we're getting over? Or is this a new structural era where supply shocks play in more than demand?
Interesting. I love in your note, you have a single sentence. It's about companies. You're going right back. There's a book none of you have read, Graham Dodd and Cottle, folks. Sold a few copies. We're going right back to securities analysis, aren't we? Like, pick a stock.
Absolutely. I mean, look at earnings so far. You've had a small number of banks report, a small number of tech companies report, and some pretty divergent outcomes there. And it's very much what are companies doing specifically to manage their headwinds.
See how she finessed that? Do you see how she just finessed the divergent outcome of banks? You know, being at Fortress Diamond, she just finessed that perfectly.
You're going to try to put her on the spot and make her uncomfortable. Mira, thank you so much. I'm not going to let you have that sort of fall. Mira Pandit, who I really like, and so I don't want you to go there and put her on the spot with something she can't answer or speak to.
Chart of the day, I saw it out on Twitter, and we're not going to get Mira into this because she's going to end up in the diamond timeout chair.
Although it's
but the answer is the singular message of this week of bank earnings is whether they planned it or not, the continued dominance of one bank in America over the next 5 or 6.
There's a bigger trend here, and I think that this is going to be one of the legacies of this period of time, and there's been a bit of research written about this, which is the bigger the company, the more power they have to adjust to inflation and to economies of scale. And in a period of transition, the bigger getting bigger. And I think you're seeing that across industries, and I think that what you see in the earnings is those that have the pricing power are the biggest names that are established and able to go around and trim things here, trim things there, and still produce revenue.
I'll go with the pricing power angle, but I would just say there's a fancy word for this, monopsonistic tendencies, which under stress read a 10-year real rate of 2.5%. The haves are getting havier and the have-nots are not. And frankly, Powell addressed that with David Weston yesterday.
Which raises the question why we haven't seen some more regional bank consolidation. Just to bring this full circle back to Herman Chan, why we haven't seen more consolidation if that is going to create a more diversified, robust financial system.
Bramo teasing up November and into Q4 there with the regional banks. It's been a more difficult tape the last 20 minutes. Futures at -13, S&P futures down 0.3%.
You mentioned that it's been a more difficult tape, but it's come on the heels of bond yields climbing to new post-2007 highs in the U.S. on the longest end. Again, though, this raises this question, who is selling and who is buying, right? I mean, is this something that is mass liquidations, or is this on the margins? The new price setters are not the price-insensitive buyers of the Bank of Japan and other Japanese investors, and frankly, the People's Bank of China.
Do we get full disinversion by the middle of next week?
We could.
I mean, that's where we're handling it. And folks, there's sort of not a belief, but maybe a theory that the stress in the system is not the inversion down, as say Priya Misra talked up. Which bank is she at this week?
JP Morgan.
Oh, I didn't know that. And then, you come up and you disinvert, and the speed of the disinversion here, I've never seen, Lisa.
This is something people are trying to wrap their head around, and it was quite clear to me yesterday that Chair Powell didn't have a clear read on it either. He did talk about the deficit.
Harsh.
No, it's not harsh. It's just reality. I mean, this is a confusing moment. Nobody knows exactly how much of each factor is driving the bond yields rising and how sticky this is. I think that is the core thing, is that, yes, all of these things are factors. Bigger deficit, buyers pulling back, this question around inflation and growth. How much each of them is a factor?
Look at that. You alone disinverted now. We're under 16 basis points on the disinversion of the vanilla 2-10 spread. That's a lot of jargon.
You knew where
there.
Priya was, by the way. You totally do.
The brain fails on a Friday. What am I focused on? How about yen? 149.95. For those of you global important. Coming up, a fiery essay in the Telegraph. John Bolton, former National Security Advisor.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
I think the American people are thirsty for change. I think they are hungry for leadership. And frankly, they know that the White House can't provide it. They know the Senate won't lead. And they are looking for House Republicans to step up and lead and make change on these important issues.
Representative Jim Jordan of Ohio earlier this hour talking about his additional bids for becoming the House Speaker. A fractious time in Washington, D.C., a fractious time geopolitically, a fractious time in markets. And I do just, Tom, want to touch on this idea that there is a real angst setting in about the lack of cohesion in Washington, D.C. at a time of incredible uncertainty geopolitically and fiscally for the United States.
And it's really been emphasized through the show this morning. I mean, a number of conversations. Greg Valliere, the congresswoman from Michigan, is well. You know, we read it in the headlines, but it's one thing to hear the people inside the Beltway, and the tone of their voices is a little bit different.
It's troubling to come to some sort of resolution and be able to pass some sort of package at a time where the House does not have a speaker. Just quickly, I do want to run you through what's going on in markets, because you are seeing a softening in the tape as you see bond yields climbing. Although off the earlier highs, you are seeing 10-year yields, though, just close to where they closed yesterday, up near 4.99%, 4.97%, just a touch lower this morning. But S&P futures hanging in there, down 0.3%. 0.3%. But Tom, I think that to me is a story only down 0.3% at a time where oil prices are climbing and bond yields are surging to the highest since 2007.
It seems ages ago, but we count it in days, where Team Surveillance said we're going to speak to people with experience. We had a Screaming Eagle of the 101st Airborne with us, I believe, yesterday. We had a Marine of Fallujah with us a few days ago. And now on the political front, we have someone controversial, opinionated. Whether you agree or disagree with John Bolton, read his Telegraph article, which sets up the region and Iran as we look at a fractured Eastern Mediterranean. He's a former United States ambassador to the United Nations, former national security advisor, and a fractious relationship with President Trump. Ambassador Bolton, thank you so much for joining Bloomberg today.
Glad to be with you.
I'm not going to mince words, John. You go back to an internship with a guy named Spiro T. Agnew. You have seen it all. How is this different from 1967 and 1973?
Well, I think in Washington, we really are suffering from an acute lack of leadership, and by a lot of people who forget that they were sent here not to represent themselves, but to represent the country. You know, you remember back in the British Parliament in World War II, when the Labour leader got up after one of Neville Chamberlain's acts of appeasement and said he was there to speak for the Labour leader who was not around. And Leo Amery, a Conservative MP, got up and said, "Speak for England." And what we need people in Washington to be doing is speaking for America, and sadly, they're not.
To look back with 2020 vision, how did we get here within the administration that you served in recently, the Trump administration? Do we have these evil and difficult events because we were off the watch 1 and 3 and 5 years ago?
Yeah, look, I think we have failed to see what's been happening in the Middle East coherently for close to 20 years now. And I think at the root of it, the principal threat to peace and security in the Middle East today, and for some years back, has been Iran. In the current circumstance, they're the ones who have armed and trained and equipped and financed Hamas. They've done the same with Palestinian Islamic Jihad. They've done the same with Hezbollah. They've done the same with the Syrian military. And remember, just yesterday, demonstrating again, they've done it with the Houthi rebels in Yemen. A U.S. destroyer in the Red Sea destroyed several cruise missiles and I think some drones heading north in the Red Sea, probably toward Israel. So the Houthis wouldn't have two rocks to rub together if it weren't for the equipment Iran has given them. Iran is the central factor here. And last night, the president's address, which was fine as far as it went, did not address that crucial point. How can you have a strategy if you don't know what the main threat is?
Who's more vulnerable right now, Iran or Israel?
Well, I think at the moment it's Israel, but I think Israel's perfectly equipped to deal with this on their own, and I hope they haven't lost the spirit they once had, which is they will defend themselves. They can do it alone. They can use weapons, but they don't expect anybody else to come and fight their battles for them, nor do they expect to take direction from anybody else either. And I do think there's something to the argument that bear hug that President Biden gave Bibi Netanyahu was not just affection, but an effort to insert himself into Israeli decision-making. Frankly, I'd rather have Netanyahu make the decisions than Biden. If you're faced with a threat like we've seen in Hamas and the deeper threat, the real threat from Iran, you know, you can live with it for a long time until you die from it. And that's why I think the government of Israel, and I think even more than that, perhaps the people of Israel, intend to see the Hamas threat eliminated in the Gaza Strip.
A lot of people are saying that one of the big sticking points for the U.S. going more aggressively after Iran right now is, A, it would cause an even bigger conflagration, and putting that genie back in the bottle is very difficult. B, you have a population in Iran that actually supports the United States and Israel to a large degree and doesn't necessarily agree with the government positions. And number three, oil prices would surge, and that would be a problem for the global economy. How important is that third factor to take into consideration?
Look, I think the concern the White House has for rising oil prices is in the United States. They're worried about November of next year. That's why they signed this atrocious agreement with Maduro in Venezuela to pretend that he's going to have free elections. and to allow U.S. sanctions on the export of Venezuelan oil to disappear. I think they're desperate not to have oil prices go up. The easy way, of course, would be to allow more oil production in the United States, but they don't want to do that because if the oil industry here got stronger, it would be harder to dismantle for their green agenda. The real question is, do you want to deal with the threat from Iran, or do you want to pretend that it doesn't exist? The administration has gone out of its way to pretend that it doesn't exist, including its chief Iran negotiator, Rob Malley, having his security clearance suspended in April by the State Department's Diplomatic Security Bureau. The chief negotiator under security investigation. It's just unbelievable.
John, my book of the year is Robert D. Kaplan's The Loom of Time, which stretches from Morocco all the way over to Persia. And the answer here, Ambassador Bolton, is we have to carve out a relationship with friends within the Middle East. How do we prosecute a new strategy with Sunni Saudi Arabia versus Shia Iran, which you consider to be our major threat?
Well, I think the threat is the regime in Iran. I don't have any quarrel with the Iranian people. We've had good relations with them before. And I think one reason that Iran took this opportunity now, and coincidentally the 50th anniversary of the Yom Kippur War, is they were very worried that the strategic closeness between the Gulf Arab states in particular and Israel might be reaching a point where they could no longer affect it. So that this, for them, for Iran, for the mullahs in Tehran, was a critical moment to act. I think things were moving in the right direction. In fact, I think if you ask the Gulf Arabs, they have greater faith in Israel's strategic vision of the region than they do with the United States.
John Bolton, one final question. What is the new isolationism of America? We want to run from this to a great extent. That's what the poll is. As we await for this war?
Not yet, but there are two factors causing it. One is Donald Trump, and I think he's had a pervasive effect, sad to say, in the Republican Party. The second is, for many years, our politicians have not treated our citizens like adults and told them what the threats are that we face in the world. I think if you talk to citizens like they are adults, they'll understand the threat. They'll do what we've always done as Americans and find ways to defend ourselves. If you act like the rest of the world doesn't matter, when suddenly find that it does, it's no wonder people are surprised if their leaders have been negligent.
John Bolton, thank you for joining Bloomberg Surveillance this morning. Ambassador Bolton, a former national security advisor. Lisa, this is just a dose of realpolitik, and as you know, Mr. Bolton is very controversial, but the idea here of Blinken doing shuttle diplomacy, what is our diplomacy? What is our theory right now forward in terms of realpolitik versus a different approach that Bolton was critical of?
One of the biggest problems right now is the confusion between parsing out regimes from the population, from the civilians. And this is one of the most difficult aspects of all of this. How do you separate out a leader or a group, whether it's Hamas, whether it's the Iranian leadership, from population that are just comprised of innocent civilians?
Continued coverage here through the day. Look for Balance of Power this evening. Joe Matthew and Anne-Marie Horton as well. In the next hour, on the bond market, the 30-year British bond is back to 1998 levels. Mohammed El-Arian recalls that. This is Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AfDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my my fear is that a significant challenge that we are confronting, and my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Your equity market negative a third of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, bond yields backing away from multi-decade highs, Middle East tension sending crude through 90, and UAW inching towards a deal with GM. We begin with the big issue. The Fed goes quiet.
Well, the Fed, I think, is trying to do is buy time.
Powell said in his remarks is, the Fed takes the world as it is.
I don't know that there was anything particularly fresh in what Powell's had to say.
It's actually a pretty optimistic speech about how the economy is performing.
Not going to take another hike off the table.
We're going back to 2%. Like the Fed is absolutely capable of getting us there.
Focus on how long the Fed has to stay on hold.
The Fed keeps rates higher for longer until they get a recession.
The Fed's on hold until they see whether the economy slows as much as they anticipated.
Powell himself said he expects growth to be below trend.
If you see inflation sort of stay at current levels, then the committee will conclude that they have to raise rates a bit.
The market's done some work for the Fed, but are we restrictive enough?
Even if they are on hold on November 1st at the meeting, high for long will still be an important part of the narrative.
Joining us now to discuss, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, always great to do this at the end of the week with you. We're entering the quiet period. That's the good news. No Fed speak for 2 weeks. Given what we've heard over the last few weeks, Mohammed, is that November meeting a live meeting still?
No. I mean, I think the market is absolutely right in thinking it's the minimus probability that we get a hike in November. You know, John, it's good and bad news that the Fed is going quiet. It's good news because that added to the instability. I was really intrigued yesterday during the event at the Economic Club of New York. When the speech was released, the 10-year went down below 490 and stayed there as Chairman Powell was reading the speech. And then when the Q&A started, it got crazy. We saw it go all the way up to 499 and then come back down. And it just shows you that right now, it's very hard to strike the right balance when you're talking about monetary policy. So it is a good thing that they are going quiet because that's a source of instability. But fundamentally, we need them to stabilize the bond market. The bond market is critical, as you know, for other markets, for the housing market, for the economy, and all this in the US and beyond. And we're not going to get stabilizers from the technical side. We're not going to get stabilizers from the economic side. So we desperately need stabilizers from the policy side.
Well, let's talk about where we've been. We were at 330 on a 10-year in spring of this year, following the collapse of a couple of big banks. Mohammed, since then, we've added about 170 basis points. The question we've had of Fed officials now for weeks is whether that's a substitute for further tightening. Haven't they basically said that it could be, or at least on the margin?
They have, but they don't quite grasp that there's a big difference between the market tightening the long end and they acting on the front end. And just look at the shape of the curve. Look at what has happened to US 10-year yields relative to Germany. That differential now is at 205 basis points. It's almost double what it was 12 months ago. So yes, it tightens, but it also, and that's what the markets are really worried about, it also opens a bigger scope for accidents, for something breaking. In fact, I'm quite struck by how often that phrase, something breaking, has been said on Bloomberg TV and elsewhere.
Well, let's get into that. The question I've asked a few times this week, Mohammed, I'd love your response to it. Do you think we fully realise the pain associated with the losses in the long bond? Not just in the Treasury market, but also in bonds, in gilts, worldwide.
We haven't, John. It still hasn't gone through the system. You know, this morning, the 30-year gilt is at a level we haven't seen since 1997 at 5.15%. There are people holding these instruments, and some of them have to be repriced, and there will be implications to that repricing. So we haven't. You know, the biggest risk, and you and I have talked about it, is that what has been relatively contained interest rate risk becomes credit risk and liquidity risk. That is the one thing we want to avoid. And the longer the instability in the bond market continues, the longer we lack anchors, the greater the probability of interest rate risk contaminating other risk factors, particularly credit risk and liquidity risk.
I don't mean to make this sound easier than it is, but don't we have an idea of the timeline for that, the calendar, given that we know where the maturity wall is for high yield out in 2025? Don't we have a decent understanding of that?
If it were just the maturity wall, yes, we do. Yes, we do. But what do you do with things that are stuck on balance sheets that need to be liquidated? It is very difficult to make the judgment as to when that is going to come out. It is very difficult to...
I think we've lost the connection with Mohammed. We're going to try and re-establish that. He's in the middle of his thoughts there about the prospect of forced selling. He mentioned gilts. Think about where they've been. If you look at the 2050 note that was issued back in 2020, so 30-year debt in the UK government bond market, that's trading in the 30s. That's a 60% move lower in the price of that bond. This is what we're talking about here. The losses in bonds are absolutely massive, huge in gilts, in treasuries at the long end. And this is something the Federal Reserve and Chairman Powell are thinking about too. Mike McKee's going to join us now to go through, Mike, a week full of Fed speak. I think we had a year's worth in a week going into the quiet period.
Yeah, I was going to mention to Mohammed, this is not the Fed blackout. This is the Fed brownout. There are 3 Fed speeches next week. They're on the payment system, so they're allowed, but you are going to have to pay attention to the Fed next week, too. Let's take a look at what Mohammed was talking about here. This is the 10-year, the circle on the left, when it broke down yesterday during Powell's speech when he said the Fed was going to be careful going forward and that they could take their time and they didn't want to go too far, and everybody sort of started pricing out any further moves. And then he came back a little bit later, and here's what he had to say. Additional evidence of persistent above-trend growth or that tightness in the labor market is no longer easing could put further progress on inflation at risk and could warrant further tightening of monetary policy. And then he said to David Weston, I think the evidence is not that policy is too tight right now. So that's when we got the other big jump up again. And now everybody is thinking, okay, not November, maybe December. Maybe we're going to be talking about rate increases down the road. And here's why. Look at the chairman says that we're worried about persistent up above 10 growth. Next week we get the GDP numbers, and as you can see, I showed this chart yesterday. The Atlanta Fed GDP now and the Bloomberg nowcast both have us above 5% for the third quarter. That qualifies as persistent above trend growth. Then we'll have to see what happens going into next year. And that's the funny part, is when you look at what the expectations in the Fed funds market are, you can see that we have nothing for November, and then the market does expect rates to go up again. But then we hit 2024, and it's just one long series of massive rate cuts. It kind of tells you, John, after the end of this week, everybody who's spoken, and of course the chairman who's the most important, that nobody really knows what's going to happen going into next year. And you can't take any of these futures seriously with the possible exception of November because it's just around the corner. We're going to be adjusting to events around the world and the U.S. economy on a sort of day-by-day basis.
Oh, to have an outlook right now, Mike, is almost impossible for officials, for market participants. Mike, can you imagine an economist at the moment on Wall Street trying to put together a 2024 outlook in the middle of October?
Yeah. And this is the time when they're supposed to be doing it. I go back to the immortal words of the Hollywood screenwriter William Goldman, who once said, "Nobody knows nothing." And I think that's kind of where we are right now. And Jay Powell pretty much admitted that to David Weston yesterday. They don't have a lot of confidence in what's going to happen going forward.
I look into the next round of forecast towards the end of the year. Mike, thank you, sir. As always, Mike McKee. Pleased to say we've re-established that connection with Mohammed. Mohammed, let's talk about the Fed's job going into next year. And at the moment, how do you weigh this bond market sell-off, the tightening that's in the pipeline already relative to the incoming data? You've talked a lot about how hypersensitive this Fed is to incoming information and the lack of a strategic view looking out beyond November, beyond December. What needs to take place now?
So I think they need to pivot from excessive data dependence to data dependence that has a greater forward-looking component. And that's what I was hoping would happen this week, and it hasn't happened. So we are going to remain in the situation of great uncertainty because there is no vision as to where this economy is going. And remember, John, it's not just about the uncertainties to do with financial accidents with the economy. It is about the serious debates, and Chair Powell referred to it. Where's our start? What are the lagged effects of monetary tightening? What about QT? What about the monetary policy framework that's outdated? So there's a lot of things that need to be discussed and fixed in the Fed complex.
Is it a mistake to address that with any kind of vision, Mohammed, when you just don't know? What do you say?
You've got to have a vision, John. You cannot drive a car without some understanding of what the road ahead looks like. You can't just look at the rearview mirror and try to adjust to every curve you just had. That's not how you drive policy. And it's certainly not how you drive policy when the impact of policy happens with a lag. So, yes, you've got to have it. This is the first Fed I know that hasn't gotten it.
Well, let's go one step further, Mohammed. What would your vision be?
So my vision right now, as you know, is that we live in a world where the supply side is a problem. We're living in a world where the U.S. economy is weakening. Therefore, be careful of too much hiking. That's the balance of risk, excessive hiking. We still have the lagged effects in the pipeline. We still have the QT effects. So I would make it very clear that I'm unlikely to hike unless I am surprised in a very big way by the lagged effects not happening. I would also add that we need to have a discussion about the path to lower inflation, because there's a risk that if we try to get to 2% too quickly, we are going to break something in the economy and something in finance because we're not relaxing the supply side problems.
Mohammed, always appreciate your perspective. The good news, no more Fed speak after Saturday, at least for a week or so. Mohammed Al-Erin, a good friend of this program and a good friend of mine. The latest from Bank of America. Fed commentary has all but confirmed the Fed will stay on hold in November. We shift the last rate hike in our forecast out to December. November is dead. Apparently it's long-lived December. Let's get you some movers going into the opening bell. Here's Abby.
Well, John, we are looking at a down week for the S&P 500, down more than 1% at this point for the E-mini futures, and we're ending the week on a down tone with futures being down a little bit. Tesla, after that disappointing quarter in color, down once again, down 1.6%, also having to do with possible China exports and reflecting the bit of a risk-off tone today for stocks. Intuitive Surgical, I was about to say iSurge, that ticker down 5.3%, third quarter revenues missed. Lots of price targets cut, but the big laggard on the day, John, SolarEdge, absolutely plunging, down 29%. They pre-announced to the downside for revenues on delayed orders. Some of the other solar companies, such as First Solar, Sunrun, down in sympathy. There is a 12% short interest into today, John. This stock down 60% year to date on the open. It's going to be absolutely brutal.
iSurge is a better name for it anyway. Abby, thank you. Coming up, President Biden addressing the nation.
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it.
That conversation up next with Crossmark's Victoria Fernandez, George Goncalves of MUFG. That's next. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
In global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose side.
Bloomberg. Context changes everything.
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it. Tonight, there are innocent people all over the world who hope because of us, who believe in a better life because of us, who are desperate not to be forgotten by us, and are waiting for us. But time is of the essence.
The president addressing the nation, making the case to fund both Israel and Ukraine. A roughly 15-minute Oval Office address setting the stage for a formal request to provide $100 billion.
American values are what make us a partner that other nations want to work with. To put all that at risk if we walk away from Ukraine, we turn our backs on Israel, it's just not worth it. That's why tomorrow I'm going to send to Congress an urgent budget request to fund America's national security needs, to support our critical partners, including Israel and Ukraine.
Team coverage starts right now with Bloomberg's Ollie Crook in Tel Aviv, AMH in Washington, D.C. Ollie, good morning.
Yeah, Jonathan, the main focus today is going to be the escalation risk and risk of spillover. Friday, another day that's been called a day of rage for Hamas. Protests across the Islamic world is what is being called for at a time when Israel continues to strike within Gaza, continues to strike targets in southern Lebanon, and at a time also when we're seeing the U.S. saying more activity on their installations in the Middle East and also intercepting apparently cruise missiles and drones from Yemen going up the Red Sea towards Israel. There's the small matter of a large nation that sits between Yemen and Israel. That is Saudi Arabia, which obviously has a very, very large stake in this, which takes us to the Arab leader meeting that is happening tomorrow in Cairo. We understand that that will be attended by Mohammed bin Salman, the president of Turkey, as well as emissaries from the Western world, and namely Europe, a number of foreign ministers there. And we say that as well, waiting for this ground incursion that could be the next catalyst for something serious. And of course, Jonathan, now 14 days into it, 2 weeks, the aid still sits at the southern border of Gaza with Egypt.
AMH, let's build on this. $100 billion. What's the response in Washington?
Well, Jonathan, there's a lot of bipartisan support when it comes to aiding Israel. But what you see in this $100 billion package, what the president said last night, today, that he will be requesting that urgent need to Congress, is the fact of the matter is that this is a number of issues the president wants to make sure is in this supplemental package. It's not just about aiding Israel. It's also about aiding Ukraine. The president yesterday really tried to link these two parallel conflicts and drawing this appeal to the American people on why it is important that these two parallel conflicts are important to U.S. security and U.S. democracy. Also in the package, Jonathan, is going to be partners in the Indo-Pacific, notably Taiwan, as well as the U.S. southern border. The thinking here is that if you cast a wide enough net, you're going to be able to garner the votes to pass this, because we do know that there are some Israeli critics in the president's own party on the progressive left. But when it comes to aid for Ukraine, there's also a lot of issues regarding the Republican far right.
MH, thank you. Alongside Ollie Crook. Ollie, stay safe going into the weekend. Thanks for being with us all week. Let's continue the conversation. Crossmarks Victoria Fernandez, George Concarvis of MUFG. Victoria, this administration wants to issue more debt. What's the price of that debt going to be?
Jonathan, I think you know what we're going to see if there's more debt issued. We're going to continue to have this supply-demand issue when it comes to our debt. We noticed it in the auctions that we had last week. We had very poor 3-year auctions, 10-year auctions, and we saw rates move higher because of that. There's also this contingency in Congress that on the Republican side, we can't even get a Speaker of the House because there is so much controversy going on in regards to spending, some of that having to do with Ukraine. So bringing this bill in where it's not just support for Israel, but linking it with Ukraine, the thought of having more debt brought in is going to really cause yields, I think, to move higher. Once we hit that 5% threshold on yields, we're probably going to see some pain in the equity market. And Jonathan, it's not just those nominal yields, right? Real yields are at 2.5%. When we get to this level, that's typically where we end up having some kind of a policy mistake. You have a lot of cash flow into the short end of the curve. The Fed starts rethinking what they're doing. I think there could be a lot of volatility around this decision.
George, your take on that. Is this Fed going to be comfortable allowing real rates to continue climbing?
Look, Jonathan, the Fed is basically in a fog. It has kind of admitted that they've lost confidence on the short-term outlook, let alone the long-term outlook. And I think a lot of that comes back to getting the inflation call wrong, and they really just want to get the job done, but they really run the risk of overdoing it. And I think they are in the process of overdoing it. And really, what's just left with is a market that's also lost confidence, especially in the bond market. We've seen some pretty big moves, and to me, it feels like a capitulation. At some point, there is a stability that comes into the bond market, but if supply keeps coming like this, I agree with Victoria.
George, bit of a chicken and an egg question here, so forgive me, but does this bond market need equities to sell off hard before bonds stabilise, or vice versa?
I do think that an asset allocation trade would help the bond market, but it's the worst timing of the year. This is the end of the year. Portfolios are not going to get rebalanced massively in November and December. This is going to be a 2024 trade. And so really, we're in this kind of less liquid, reduced balance sheet world with a lot of bonds coming to the market, both from primary and secondary. I mean, this is where I think we're going to figure out how high we can go.
It's really hard to get a clear indication of anything right now, Victoria. You look at the data, tons of broad-based strength in retail sales this week. You listen to the companies. Bank of America says things are slowing. JP Morgan's hiking guidance. I mentioned LVMH and the airlines indicating the post-pandemic boom might be over. What can you glean? What can you take away from the earnings we've seen so far?
Well, I think we take away that we're still in that car with the clouded windshield. I don't think we have a clear clear picture of really where things are going. You have all of these unknowns and these uncertainties that are out there, whether it's political here in Washington, the geopolitical issues that we're facing, the economic numbers where some are good and some are bad, inflation not coming down as much as people want. I mean, there's all of these issues that I think are really kind of counterintuitive to each other. And so it leaves you in a spot, and it leaves the Fed in a spot of saying, well, how do we approach this? What do we do with our portfolios? What is going to happen in the marketplace? And I think it's where, as investors, and what we're doing with our clients is you have to take a step back and say, let's look at this from a longer term perspective. Let's build some barbells into the portfolio on the fixed income side and capture some rates on the short and long term. When you look at equities, have a little bit of cyclicality, trim some of those other names, have some staple exposure in there. I don't think you can have a clear path at this point in time to take a huge bet on the market. I think you have to kind of buffer that a little bit at this point.
I can hear people itching, George. They're itching to buy the recovery to the recession we haven't had yet. I've heard it so many times over the last few months. You're hearing the same thing?
Look, I mean, bond investors had a really tough year for the third year in a row. And this actually is a worse year because you had that big rally in the beginning of the year, got people kind of trapped longs at the low rates, which kind of gave a leg to the housing market and to equities. This low rates that we had all the way up through the middle of the summer kind of then flipped with this big, massive bear steepening, which I've been discussing for months now. I mean, the bear steepener is what gets you. It's very grisly. It's very rare. But when it comes, it doesn't really leave anything in its wake. So the bear market in bonds is what we have to focus on. It's getting attractive. The risk reward is getting there, especially in mortgages. But, I mean, it's too convex, rate vol is way too high to get involved here.
It's brutal. Think about where the curve has been. Negative 110 basis points back in spring. Right now, 210s, negative 16. The best steepening we've seen over the last couple of months, just phenomenal. Victoria Fernandez, George Goncalves, to the two of you, thank you. Coming up, the morning calls, and later, Alpine's Sarah Hunt, expecting stocks to struggle in a higher for longer interest rate environment. That conversation a few minutes away.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Away from the opening bell, let's get you some morning calls. First up, Deutsche Bank upgrading Union Pacific to buy, pointing to a number of improving trends within the rail space. Next up, Redburn Atlantic downgrading Yum Brands to neutral, noting headwinds to the company's earnings growth outlook. And finally, Wolfe Research upgrading Morgan Stanley to peer perform, seeing limited downside after falling 8% since reporting results. Coming up, big tech earnings ramping up with FANG stocks next. That conversation coming up with Sarah Hunt of Alpine Saxon Woods. Your opening bell just around the corner.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 seconds away from the open and bow this morning. Good morning to you. Heading towards a week of losses on the S&P 500, snapping a 2-week winning streak. Right now, pulling back by about 0.1% on the S&P. On the Nasdaq, we're negative by 0.16%. The open and bow in New York rings. There we go. Switch to the board and get to the bond market. Yields look like this. We're down about 5 basis points on a 10-year to 493.71. Cycle highs this week. 2-year, 5-year, 10-year, 30-year. What a week it's been in the bond market. Even with this move lower, this week the 10-year yield higher by more than 30 basis points. In the FX market, the euro going nowhere. 105.84 unchanged on that currency pair. Crude going somewhere. 2 weeks of gains. Back into the 90s on WTI, up by 0.9% this morning. What's stock to watch at the open? Amex reporting record Q3 profits. The CEO saying this: the investments we have made in our value propositions are driving brand relevance across generations. Abby has more. Hey, Abby.
Hey, John, and yes, so there's the good part of the quarter, which is basically the surface. They did beat top and bottom line estimates, record profits, as you just mentioned, and that really has a lot to do with demand for their premium products, such as the Platinum Card, along with the Travel Gold Card. Now, speaking of travel, that's what's driven a lot of their business over the last couple of years, that revenge travel coming out of the pandemic. What that creates, though, what investors don't like, with the stock now down 3.4%, is the fact that it's tough comps. The growth does not look as attractive for American Express, given the fact that this is going on relative to the strong revenge spending. So growth in spending on the cards is slowing. It's making those unfavorable comparisons. Plus, their total network volume, while up 7%, that missed estimates. It's the lowest growth in 10 quarters. The stock on the year into today up a little bit. And right now, we're looking at the stock near session lows, down about 3%. That, of course, is the worst day in a bit of time here. And it's trading sideways, John, in a range between 140 and 180. Investors can't figure out what to make of American Express.
145.40 right now. Abby, thanks for that. Let's stick with banking. Regions Financial falling short of Q3 earnings estimates. The CEO with this line: while the industry continues to face economic and regulatory uncertainty, we're confident in our ability to adapt to the changing landscape. Shonali has this story. Hey, Shonali.
Good morning, John. When you look at the regional banks, Regions Financials is just one of those banks that have already been down more than 20% on the year. And now not only is their net interest margins missing expectations, you also have their outlook starting to concern investors, with Evercore ISI saying that it's a net negative, this outlook that they have, likely pressured on the NII and net interest margin miss, and greater pressure than expected on funding costs, expected expense noise and all that mounting credit pressure. They're one regional bank among many that are facing such problems, and you see that in the stock this morning, down another 12%. If you take a look at the KBW Bank Index, you're looking at most banks in the index certainly down. Really only JP Morgan Chase that is up anymore year to date at more than 8%, but everything else is down from 0.2% to 54% if you look at First Horizons. Not bad news everywhere. Take a look at Western Alliance really quickly here. It's getting just a little bit of a lift here on that beat. I'm sorry, everything is a miss these days. The beat that they had in net interest income. So you are seeing banks still trying to lend into this environment and also beat on credit costs, but it is a messy story among the regionals, and that continued pressure is still of great concern for credit markets.
Shonali, help me frame this. Is it JP Morgan versus everybody else, or is it the large banks versus the small banks still?
Can you say both somehow? At the end of the day, JP Morgan is just so big, and you see that in the bid that it's getting in the stock market. Its price to book ratio, it's trading at more than 1.5 times its book value, and almost everything else is starting to trade below. A really difficult moment for the banking industry here, John.
Huge gap opening up this year. Shonali, thanks for that. Thanks for the update. The latest on the financials there, the regionals specifically. Let's turn to the transports. Knight-Swift Transportation, topping profit and revenue estimates. The CEO with this line: "We remain excited about the future of this business and continue to work on growing organically and through strategic opportunities." Katie on top of this story. Hey, Katie.
Hey, John. Well, there's a lot to be excited about. You look at the stock market right now, Knight-Swift is soaring at the moment, up almost 12% or so. And let's get into some of the numbers here, because it really was a beat across the board. You take a look at third quarter adjusted EPS. It came in at about 41 cents. Analysts had been looking for 36 cents. You also saw total revenue beat as well, just above $2 billion. The estimate there was for $1.9 billion. And looking forward, Knight-Swift also narrowed its adjusted earnings guidance for the year. That topped the average analyst estimate in the process. Now, the sell side opened these numbers with open arms. You take a look at JP Morgan, they upgraded the stock to neutral, and their reasoning there was that the U.S. Express acquisition is making progress sooner than expected. Morgan Stanley, meanwhile, reinstated the stock as a top pick, and that's actually lifting industry peers as well. You take a look at J.B. Hunt and C.H. Robinson rising alongside Knight-Swift right now.
Katie, thank you. Thanks for the update. Look out for Katie later at the close with Romain Bostic. Looking at that name, this name on my screen right now, Tesla. Tesla yesterday with a really difficult session, down by more than 9%. Biggest one-day loss since July. The latest news on Tesla for you this morning, recalling over 4,000 Model X vehicles in China due to brake issues. This according to a statement from a Chinese regulator saying the following: "The alarm may not be issued when the level is low. In extreme cases, it may affect the vehicle's braking and increase the risk of collision." Ed Lovedo with the update. Morning, Ed.
Yeah, good morning, Jonathan. Tesla down 2.4%, extending its declines. This puts Tesla on track for its biggest weekly drop of 2023, the worst week of the year. A lot of that downward pressure continues on from Wednesday night in that quarterly earnings report, where there was a top and bottom line miss, reiterating guidance that it will deliver 1.8 million units this year, or produce 1.8 million units this year, but much bigger macro concerns. As it relates to the China recall, this is a soft recall in the sense that those more than 4,000 vehicles that are impacted, the solution is an over-the-air update fix, which is a pretty commonplace occurrence when it comes to so-called recalls out of China that are mandated by the regulator. But, you know, the story's really changed, right? Elon Musk really focusing on the rates narrative, the macro environment that Tesla is operating in, and now there is a concern that the lever of price cuts that they've used to drive growth, which the target is 50% annual growth for Tesla, it won't work going forward, and it's not going to be the same sort of effective lever. And if you go on ANR on your Bloomberg terminal, it's just interesting to see on a 12-month price target basis trajectory change and where analysts see this stock going right now.
Ed, this just isn't a Tesla story. It seems to be the whole sector. I hear a lot of reports about EVs, unsold EVs piling up. Ed, what's happening?
Yeah, I think especially if you read our own Bloomberg Intelligence analysis, there is now a question mark over how robust consumer EV demand is, right? And I think that the story that will be increasingly written is that those early adopters, those most inclined to transition to an electric drivetrain, may have done so. How do you take the rest of the market? You know, the way that it gets explained to me by investors and market participants is like, a car is the most expensive thing you'll buy in your lifetime apart from a house. And the rate environment impacts that. Financing of those cars impacts that. And even though prices have come down, largely driven by Tesla's price cut initiative, it's still elevated for a battery electric vehicle relative to a combustion engine car for most middle income households, particularly in this country, John.
It's too expensive. Ed, thank you, sir. The latest on autos. Let's talk about houses as well. We put out this story yesterday. Home buyers needed a $114,000 salary to afford a typical home in America in the month of September. This assumes a 7.2% mortgage rate, if you can find one that low, with 20% down on a median price home of something a little north of $400,000. This according to real estate brokerage Redfin. To comfortably afford a home payment, this is the basic assumption, a buyer should spend no more than 30% of their income on housing costs. So let's go back to what this used to look like. Think about back in, say, 2012. The average requirement was roughly $38,000 to access the average home. It is now 6 figures, $114,000. Salary. Is it any surprise that people can't afford the EVs that are coming to market? Let's talk more broadly about the broader financial markets. Sarah Hunt of Alpine Saxon Wood seeing a challenging road ahead for equity markets, writing this. A higher for longer rate environment risks the repricing of assets after more than a decade of zero rates. It seems very unlikely that repricing would be to the upside. Sarah Hunt, I'm pleased to say, joined us right now. Sarah, let's talk about what companies are saying about this economy and who's got pricing power. We just talked about Tesla cutting prices. Yesterday, Netflix, we could talk about them hiking prices. Sarah, who's got pricing power right now?
Very uneven across different sectors, and I think that this is part of the problem and part of why people are having trouble figuring out what happens into next year. I would argue that it's going to be a challenge to think that you can get a 12% earnings growth for the entire S&P. I think there are some places where you will get it. I think you've seen some pricing power in some of the technology sectors. I think you've seen it in some places, but higher interest rates really takes a bite out of that pricing power, especially when you're talking about high-ticket items.
It's so difficult to get a read on discretionary spending right now, particularly given the example I just gave. But if you throw in what we heard from LVMH saying that they've seen the post-pandemic boom, it's over. What the airlines have indicated this week, American Airlines again. Sarah, where do you see that strength for the consumer at the moment? I see it in retail sales, but at the sector level, at the stock level, where do you find it?
I think you have to look at some of the smaller budgetary items, because think about that. I mean, what just happened with American Express too. I mean, we're saying we've got really good numbers and everything's going really well, but you're seeing a drop in that growth of travel spending and some of those expensive items. I think that's really the problem. Some of your textile works. Are you still going to buy an iPhone? You probably are. Are you going to take an extra vacation? You might not. I think that there's going to be a real change in the way that we've been acting, and how to predict that change is obviously one of the biggest challenges that we all have right now.
Well, the consumer for most of this year, as you know, Sarah, has been surprising to the upside. I've called it the 3-month rolling recession call. We just keep pushing it out. Barry Bannister of Stifel was on a program earlier this week. He was talking about the slowdown coming. Guess when? Back half of 2024. Is the bigger risk for you, Sarah, that that slowdown comes sooner or it gets pushed out later?
I think the biggest risk is that we have this, not just the rolling recession call, right? It's also the rolling what's going to happen with interest rates call. The chart that you put up earlier when you were talking to Mohammed Al-Arian, where it looks like we have 1 or 2 more rate hikes and then all of a sudden we see rates come down dramatically. The market's also been pricing that combination of we're rolling out a recession, we're going to have rate cuts. And I think that the strength in the consumer has had, and the labor markets has had this effect that has allowed companies to continue to earn. The question really is, when do those margins start to get hit? And that has been the magical question. And so far, no one's actually nailed the timing of it completely right. But I think that you do start to see some weakness. You're seeing it now in the way that companies are talking about their forward numbers on their third quarter calls. And I think that as we get through this earnings season, we're going to see some projection of that. Although I doubt you're going to see anybody who wants to tackle what they're going to look like in 2024.
Let's work through the market right now. What's playing out on the screen? The 10-year yield lower by 6 or 7 basis points, pulling back from multi multi-decade highs at the front end. We were through 520 early this week. We're down 5 basis points this morning to about 5.1%. On a 30-year, the 2-year is basically where the 30-year is right now. The 30-year is at 5.077%. That yield's lower by about 3 basis points on the session. That's the bond market. About 12 minutes into the equity market session, we're negative by just 0.1% on the Nasdaq. On the S&P 500, virtually unchanged. If you're looking at crude, back in the 90s, Sarah, WTI, $90.30, up by 1% this morning. You've had a preference for energy for a while. Sarah, is that a place you want to stay?
I think it is. I mean, the really unfortunate thing is that what's going on right now in the Middle East only exacerbates the problems that you see in the energy sector. And I think that this consumer reluctance to get to the next level of EV vehicles, I think there's still challenges. And the hydrocarbons that people have been talking about phasing out over the next decade or so, I think are here to stay with us longer. And I continue to believe that energy is not a bad place to be. And I think that right now, unfortunately, for everybody, that is coming to the fore in a geopolitical way as well.
Big combination with Exxon in the last couple of weeks, Sarah. Are you expecting to see more of the same from others?
I think you will. I mean, I think that, it's hard in the energy stance to say that all the acquisitions end up making sense. They certainly sometimes take a couple of years to play out. And I think that you are going to see that. I mean, this is all about efficiencies, right? In the end, there's also what's coming forward in the next year or two. Well, people are looking for ways to save money. Well, how do you do that? You combine into a bigger company, and then you can take some of the costs out. Look at all the announcements that are being made right now after Credit Suisse was absorbed. I think that there's going to be continuing merger and acquisition activity, because I think you have to be bigger to be able to navigate some of the cost structures and some of the political structures as well.
Sarah, great to catch up, to get the update from you, the team. Sarah Hunt there of Alpine Saxon Woods. If you're just joining us, we're about 13 minutes into the session. We are pulling back just a touch, no drama. We're down on the week, down just a little bit on the session by 1/10%. Coming up, some potential progress out of Detroit.
As the UAW strike against Ford continues, we are at a crossroads. This is about the future of the American automobile industry.
The UAW inching closer to a deal with General Motors. That conversation up next.
Names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
I know one of the reasons you're here in Marrakesh and in Africa, because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal, and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
Trends in global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield, because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
As the UAW strike against Ford continues, we are at a crossroads. Choosing the right path isn't just about Ford's future and our ability to compete. This is about the future of the American automobile industry. It should be Ford and the UAW versus Toyota, Honda, Tesla, and all the Chinese companies that want to enter our home market.
That was Ford Chairman Bill Ford speaking on Monday. Today, the union and GM moving closer to a tentative agreement, according to a negotiator. UAW Vice President Mike Booth saying this: all the pieces are there, we just have to glue it together. Attention now shifting to Union President Shawn Fain, expected to provide an update at 4 p.m. Eastern Time. Your team coverage begins right now with Bloomberg's Anne-Marie in Washington alongside David Welch over in Detroit. David, first to you. Are we close to a deal here?
Well, look, there's some operative words here in that story. First off, the headline, inching toward a deal. So they've probably got a few feet to walk, but they do need to glue all this together. I think Mike Booth is giving us the straight dope on that. The trouble with these labor deals is often it gets down to the wire, like, you know, fairly close, like I think they are, and somebody wants something else, and that could take more time to iron out. You know, like GM still hasn't come to 23% pay increase over the 4 years. They're at 20%. Ford's at 23. I think they're going to have to do that. And Mike Booth also told us yesterday they still need to come to an agreement on retiree benefits. It sounds like it won't be a pension. It'll be a 401k, but a very nice one, and they still need to finalize numbers on that. And then, you know, there are side letters on how they will handle future battery plant workers. I think they probably have a decent understanding there, but then once the attorneys get in and the specifics happen, these things can take a bit more time. But this is the most positive commentary we've heard from either side about this probably the entire time, because there's been a lot of nasty rhetoric for the last 5 weeks.
True. Excuse the pun, but how much gas is in the UAW tank? Can they afford to drag this out much longer, David?
Sure, they haven't actually spent all that much because they're really only striking a small number of plants and a relatively small number of workers. They had about $825 million going into this. They could have struck every plant at all three companies for 7 weeks, and they've spent far less than that. It's been 5 weeks at just, you know, a relatively small number of facilities. So they've got money to continue this.
What would trigger an escalation for them, David? What do you think it would be? We heard about the F-Series plant being targeted. What would be the escalatory move from UAW now for these three automakers in Detroit?
I think when Shawn Fain takes the Facebook Live event at 4 o'clock, if there are just a few things that he really wants, and they're just not, he's not getting exactly what he thinks will move the needle, then he could put up some last-minute pressure by walking out at some other plants. You know, when Mike Booth says the pieces are there, but they need to be glued together, I think there is a general framework, and that the union has, as Ford has said, pushed the companies almost as far as they can in terms of what they are willing to spend on this 4-year labor agreement. But you know, the last minute, the union can apply pressure to try to squeeze a little bit more out of the companies, and with a lot more in their strike fund to do it, I think they could.
MH, for good reason for this White House. This story's fallen off the radar. Where's it going?
Well, Jonathan, I think if there's able to be an agreement, that's going to be welcome news for this White House. They want to see a fair agreement for the unions, but obviously, of course, they'd like to see this be done and finished with so they can move on, because the concern is that this can cause a recession in a place like Michigan. I also like to note, Jonathan, I was pretty struck by some of the numbers we saw yesterday in the Bloomberg News Morning Consult poll. While Biden does hold the union vote still overall, he beats Trump by 11 percentage points. Look at these pockets in some of these swing states like Arizona, Pennsylvania, and Wisconsin. Trump is eating at those voters. So for President Biden, this shows to me, yes, he wants to be the most pro-labor union president in modern history. We all know the slogan. but it does look like he still has some work to do.
To your point, does he have the union vote, Anne-Marie? And if he doesn't, does the former president have it?
Well, that's a great question. At the moment, according to our poll, overall, he has the union vote. But the issue is that former President Trump is starting to eat away. He is starting to gain favor with some of these union households. Look at a place like Michigan. Our poll shows that Biden holds the union households by 11 percentage points in Michigan. In 2020, John, when he won Michigan, he had about 25 percentage points of those union households. That's less than half. So it shows to me that the president has a lot of work to do, and also potentially being the most pro-labor union president isn't necessarily top of mind of these voters. What is top of mind of these voters is inflation and the fact that they feel like their wages are not keeping up with the price of everyday goods like groceries and like gasoline, Jonathan.
MH, thank you. Alongside David Welch on the latest from Washington and Detroit, respectively, inching towards a deal between UAW and GM. As David Welch put it, maybe, sure, we're inching towards a deal, but we still have a couple of feet to go. If you're just tuning in about 23 minutes into the session, pulling back by 0.2% on the S&P. Let's get you some sector price action. Here's Abby.
Interesting sector action today, John, because we do have this small decline for the S&P 500, and yet more sectors are higher than not. And also interesting is with yields down, we have some of those rich dividend sectors on top, real estate, utilities, consumer staples. Toward the bottom, we do have energy, even with oil higher. On the week, we are, of course, talking about that first down week in 3, as you mentioned earlier, down about 1%. Two of the best sectors, energy and consumer staples, and then two of the worst sectors, real estate and discretionary. Most sectors, not surprisingly, on the week are down, again, with the S&P 500 heading toward a 1% loss.
Abby, thank you. Up next, a sneak peek of next week, your trading diary coming up.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
This is Bloomberg.
Stocks down just a touch on the session and on the week. We're down by 0.2%. That's the price action. Let's get to the trading diary. Coming up, the US-EU summit kicking off at noon Eastern from the White House. Plus, Fed President Mester speaking before the quiet period. Next Tuesday, earnings from General Motors, Alphabet and Microsoft. Wednesday, Meta and IBM. Thursday, more results from Intel and Amazon. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. I'll be away next week. I'll see you the week after that. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing? I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. A little bit of sell-off here in the equity markets to start the day. Coming up, we're going to check in with Kate Ackley, reporter at Bloomberg Government. She's going to give us the latest on the House of Representatives as they try to elect a Speaker of the House. And then we're going to get the latest on Israel. Micheline Ishay, she is a professor at the University of Denver, going to give us the latest there, talk about how this might play out. And then we're going to talk about markets. Stephen Whiting, he's a chief investment strategist at Citi Global Wealth. So we'll talk about his view on these markets. But first, let's kick things off this morning with a Bloomberg Business Flash. Denise Pellegrini.
Yeah, a lot of things kicking at us, including rising Treasury yields, guys. It's 10:01 on Wall Street. We check the markets all day long for you here at Bloomberg. Crude oil also surging, and stocks are lower. Chris Grisanti, chief equity strategist over at My Capital Management. Well, he tells us just because companies did well last quarter, he says, don't think that's going to continue. Things, he says, could really change on a dime.
In the last month, after earnings have been recorded September 30, the long rates are up a lot. And, mortgage rates are just about hitting 8% now on average. And, we're entering a different place, I think. And I think that place is going to be harder. And historically, whether it's 2007 or 2000, the economy stops pretty quickly. Like in the last quarter of 2007, the GDP grew by more than 2%, and the recession started the next month. So I would urge investors to be kind of cautious and don't take, past history, in this case, third quarter earnings, to be indicative of what's going to happen over the next few months.
And Grisanti with us there on Bloomberg Surveillance. And there is some caution in the markets right now. The Dow down 0.2%, 77 points lower. The S&P 500 down 0.3%, 13 points lower. The NASDAQ down about 1/3%, down 39 points. That yield on the 10-year, 4.9 3%, we'll call it right now. Other big story today, spot gold, it's surging again. We're above 1989 an ounce right now, ever closer to that 2,000 mark that gold bugs have been talking about. 2,200, I think they've been talking about for a while now. We'll see. And crude oil right now, it's up almost 1%, up 0.9% right now. We are sitting above $90 a barrel. Just want to get back to treasuries for a second. It's not just the U.S. and the U.K. The 30-year bond yield has just risen to the highest since 1998. American Express had an earnings beat, but that stock is lower right now. And that is a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're also streaming live video on YouTube, so head over to youtube.com and search Bloomberg Radio. And Matt, we're starting out the day here. We have to pull back a little bit here in yields, but they're hitting some of the the highest levels since 1997 in the Treasury market. And we were talking to Ira Jersey just earlier, Matt, Tom Keene and I, and Ira's put out a note. And he's kind of, for the first time in a couple of years, he's saying to investors, maybe time to start dipping your toe in treasuries.
And I mean, it makes sense. I'm looking at 5.3% on the 20-year right now. Maybe you don't want to go that far out the curve. I get it. You're sitting in 2 years, right? Still at 5.1% there. But we're seeing the belly of the curve really push higher. So the 10-year right now, 4.933, and the 7-year is 4.939. So, yeah, these are the kind of yields that we haven't seen in decades, approaching a generation.
Yep, absolutely. And so I looked at, because at Bloomberg, you can see what people are doing, what meetings they have, because that's called transparency.
Oh, you spy on people's out function?
Absolutely. So and I looked at Ira. He's got a full week of meetings over in the UK. But then I sussed out of him. He's flying over tonight so we can go to the Aston Villa West Ham match on Sunday.
The soccer thing with him.
Mixing up. All right, let's get right to it because we need to get down to Washington, D.C. because the House of Representatives still does not have a speaker. Kate Ackley, she's a reporter with Bloomberg Government. She joins us here. Kate, what's the latest here? Is there any reason to believe that today or in the next few days this House of Representatives can get their house in order, so to speak, and elect a speaker?
Well, we're watching. The House has just opened up for the day. Basically, they're going to start with a quorum call, I think, and then we'll see if there's going to be a vote. That's the plan, that this would be the third vote for Jim Jordan, the Republican of Ohio, to be Speaker. And, I don't think we have an indication that there is going to be a hugely different result than the first two votes where he was obviously not elected Speaker.
So why is he doing it again?
I think this is part of an effort to, keep the fight up, keep the pressure on some of the holdouts. So we'll see if that is successful
There's
or
so
not.
many holdouts. It's not like 6, right? We're talking 20.
20 plus, right? And I guess that, when you do the roll call vote today, you'll see, is it still 20 plus? Is it more? Did some people, come around to Jim Jordan? Did some people decide they're not going to vote? They'll vote present. Absences is another thing that we'll be watching. There are already a couple of members of Congress who are not going to be there today. There's one who's in Israel doing sort of what I think he called a fact-finding mission. And then, there are going to be other people that leave. It's Friday. Members of Congress, they don't typically stay in a 5-day week, if you will, in the Capitol. So there are going to be people trickling out. And Congressman Jordan has said he wants to have votes all through the weekend, potentially. And that's when the, absences may become a real problem for him.
So is the House prepared to go, like 15 rounds like they did for Speaker McCarthy? Do they want to put themselves and the country through that? Where do we stand on that?
There have been a few Jordan loyalists that have said, I do 100 rounds for him. But I don't know, does the Republican conference have that appetite to continue round after round? Some do. Will this convince some of the holdouts? Will it strengthen some of the holdouts to stand firm against Jordan? We basically have more questions right now than answers, but we'll get a few answers in this third vote for Jordan's to be Speaker.
What's interesting? On Friday, they leave and they take a long weekend, right?
Yeah, I mean, what's up with that?
No, we do it too, obviously. That's just how it goes when you're very important. But
please.
I heard from someone that before like Newt Gingrich's time, there was a forced residency where all of the congressmen had to live in D.C. And then as a result, like their kids go to school together, they're at cocktail parties, they have to get to know each other. The wackos don't have as much power, right?
That's a good point. Yeah.
Is that, Kate, you think part of the problem with the insane polarization and the insane people that are elected to Congress?
Well, I have heard that criticism before, that they're not spending as much time socializing. People, leave for the long weekend, go back to their districts. Members keep their children, if they have them, in school, in their congressional districts. That's their home. Some of them have slept in their offices, so they don't even have a real DC residence or DC area residence. That's probably part of it. But I think in my conversations with members of Congress, academics who cover Congress and study Congress, I think it reflects more just the country. The country is polarized, and the people, the voters are sending representatives to Congress that reflect the polarization of the country.
All right, Kate, thank you so much for joining us. Kate Ackley there, reporter with Bloomberg Government, giving us the latest on the House of Representatives as it attempts to select a new chair. We're just looking at some video feed here where they're all they're calling in and kind of registering and kind of saying who's here, who's not, that kind of thing. So that's what's happening right now.
They're getting in, they're getting their coffee.
Sure. I mean, hey, it's 10:09. God forbid
hanging out with
you
friends.
start the day a little earlier.
Yeah.
So anyway, let's switch gears. Let's get back to the leading geopolitical issue out there, and that is, of course, what's happening in Israel. Micheline Ishay joins us. She is a professor at the Joseph Corbell School of International Studies at the University of Denver. She joins us here. And Micheline, thanks so much for joining us here. What do you believe Israel should do in response to what was almost 2 weeks ago, the terrorist attack? What do you think they should do here?
Well, as any country that has been attacked in an unlawful manner, with an intensity and a scope that was unprecedented, it's clear that it has to defend itself. It will defend itself, as we heard in the media, by just sending ground troops now. It took some time to do that because it wanted to sort of somehow shelve the infrastructures of the northern Gaza in order to send its troop. Now, you ask about what it should do. It has the right to self-defense under international law. It has, of course, to be consistent with not creating excessive death that surpass the military advantage, which will be a difficult call. But what it should do and will do will probably be defending itself. And here we all hope that it will be done with international law in mind.
So do you have problems with the blockade that now has kept humanitarian aid out of Gaza? I mean, you could understand the anger, right? Obviously, initially, but then there are over 1 million people in Gaza under the age of 15. So, they weren't even born when the Palestinians elected Hamas in 2006. Is that something that the Israelis need to be better at doing, letting food and medicine and water, maybe even fuel through? Or, do you see that Hamas just takes what they want right away and doesn't care about the rest of the people? And so it's kind of fruitless.
Well, it's probably one of the concerns of the Israelis that Hamas might be taking some part of the humanitarian aid that will be delivered.
Well, not just might be. I mean, definitely, right?
Most likely.
They butcher babies. Likely. They stole already a lot of fuel that went in last week. Yeah.
So there will be an need of an important triage, the question who is going to be doing it. At the same time, you have, as you said, a humanitarian crisis with close to 1 million of people now trying to evacuate to the south of Gaza, a very small strip of area with a highly densely populated people. So there will be opening as a result of the Biden visit to Israel. There will be an opening of truck delivering food and water. It's very unclear as to what extent there will be electricity, because the electricity can be used also for warfare purposes, but there will be certainly situations in which we will see in the coming days opening in the Rafah crossing, at least from what we hear from the Americans and the Israeli as well.
Micheline, how concerned are you about this conflict, which is currently between Israel and Hamas, broadening out to something that includes more of the Arab players in the region? How much of a risk do you think that is?
It is always a risk. We know that Iran has sponsored Hezbollah and also Hamas. And we also know that there was just yesterday or 2 days ago, just missiles that were intercepted by American boats launched toward Tel Aviv. So there is a possibility always of a war to spiral in the wrong direction. At the same time, it's worth suggesting that the fact that Iran has been very much weakened, years of protest also in its own country. Hezbollah has become also very weak. Party in Lebanon, and Lebanon has been becoming a failed state. So those two countries, though they might want to unify and they might want to show their support to the Palestinians, also are hesitant in full-fledged involvement. So they are waiting. I think that if they see that there is in the north of Israel more infights or missile rockets going in the directions from Israel to Hezbollah, they probably will be further involved. What is reassuring in a way is that the United States has sent its 2 aircrafters onto the East Mediterranean Sea. And in that sense, it provides a form of deterrence to the potential escalation of countries in the region.
And Professor, I guess, can you help us just understand kind of the support that Hamas enjoys in Gaza among the Palestinian people, I guess? I'm just wondering to what extent...
So hard. It's been a question that's really hard to get an answer on.
Do the Palestinians support Hamas, and if so, to what extent do you think?
I think that if you were asking the same questions in October 5th or 6th, you probably will see a lot of dissent among Palestinians with respect to their support of Hamas. Remember that the last elections in Gaza Strip was in 2006, which means it was 17 years ago. Very difficult to assess that level of legitimacy. Moreover, we know that Human Rights Watch have criticized heavily Hamas for detaining, incarcerating, torturing its own people and not being the most friendly when it's come to their women's rights. So a lot of dissent among its population. But you can make the same argument, not quite the same, but a somewhat similar argument with respect to the Israeli. They have distrusted their government now since November 2022. It was an elected government, but still very much distrusted as a result of the protest movement. Nonetheless, during time of war, there is a unity. 300,000 people have been mobilized among the reservists to fight that war unconditionally, and among them many protesters. So I will assume that the same will happen in wartime on the other side.
How would a human rights advocate prosecute a war against an enemy that doesn't care about its own people? That even takes refuge in, Hamas military activities come out of schools and hospitals, that use their own people as a defense. How do you prosecute that kind of war if you're concerned about civilian, injuries and deaths?
Well, it is from an international humanitarian law, certainly a very difficult proposition. First of all, as you know, international humanitarian law have to be reciprocal. So it has to be consistent for Hamas side and for the Israeli side. Even if one side does not do it, the other still has the burden of being constrained by those international law. How it prosecuted will be very difficult. Israel has the right to defense with respect to international law, but it has also it's constrained with respect to how it target military versus civilians. Civilians, as you said before, are already part or already embedded in the military wings of Hamas, which makes it very difficult to go after the military wings of Hamas. But what the Israelis have done and have tried, at the very least, it's to, first of all, called for an evacuations of the north side of Gaza to the south of Gaza in order to make sure that the object of target was not the innocent civilians, but the military wing. Very difficult to do on the long run because there will be excessive casualty in the crossfire.
Micheline, thank you so much for joining us. We really appreciate getting the benefit of all your experience. Micheline Ishay, Professor of International Studies and Human Rights at the University of Denver. And folks, I'm just looking at her bio, and she's been everywhere talking about human rights and teaching about human rights. We appreciate getting a few minutes of Professor Ishay's time. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, shares of American Express are down more than 4% despite a robust third quarter. Bloomberg's Gina Cervetti has more.
American Express is pulling in more new cardholders willing to pay an annual fee for its premium products. That helped fuel soaring third quarter revenue and profit, which hit record levels. Amex saw a 20% increase in net card fees. The company said fee-based cards accounted for more than 70% of all new accounts that it added in the quarter.
Thanks, Gina. CVS will reportedly stop selling cold medicines containing phenylephrine as the only active ingredient, Bloomberg's Joan Doniger reports.
Steve, CVS made the decision to pull products with phenylephrine after a panel of FDA advisors recently concluded the nearly century-old ingredient doesn't work, even at higher doses. That's according to the Wall Street Journal. Regulators have not asked retailers to remove the products in question from stores. CVS is voluntarily doing so. A spokesperson says the company will follow any FDA guidelines to ensure compliance. Phenylephrine is found in many decongestants and over-the-counter medicines to clear clogged noses. Steve?
Thanks, Joan. CVS stock currently down less than 1%. And a medical sterilization company has agreed to settle nearly 80 lawsuits alleging people were exposed to cancer-causing chemicals emitted from its plant outside of Atlanta. Sterigenics, in a statement, denied any liability, and under terms of the settlement, the 79 plaintiffs must agree to dismiss their claims with prejudice, meaning the decision on those cases is final. And those are the company news stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We have the major stock averages. They are lower as we close out the trading week. The S&P 500, 31 points lower. That's down 0.75%. 42.46 on the index. The Dow Jones Industrial Average, 198 points lower. The NASDAQ 100 down 96 points. That is down about 0.7%. A bit of relief as far as rates, very little. 30-year down 1 basis point, 5.09% right now on the long bond. The 2-year down 6 basis points, that's at 5.09%. And the benchmark 10-year yield right now, 6 basis points lower, 4.92. Nobody's about to call this peak rates, though. In the S&P 500, only 2 of the major industry groups are higher right now. That belongs to real estate and consumer staples. That's where you find shares of Procter & Gamble. And at the bottom of the bunch, energy is the worst performing group right now in the S&P 500. And a quick look at oil in the commodity space. Despite that, NYMEX crude up 68 cents a barrel, above 90.05 a barrel. Economists surveyed by Bloomberg lifting their short-term projections for U.S. economic growth, also trimming the odds of a U.S. recession. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. There is a rumor going around that Matt baked or has cookies?
Yes. Dude, did you not have any yet?
No, I
They're
wasn't offered.
They're on the printer.
But may I, before I partake, can I ask, are they the normal ingredients that a
good
person like
question.
me would
Let me
consider
just
normal?
put it like this.
Is
They're-
anything
they're
going to happen
legal
to
in
me?
New York.
They're legal in New York.
Am I going to go schizo if I have one?
No. Only if you start at a very young age and have some every day.
It's a gateway cookie. All right. John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. All right, listening to Fed Chairman Jay Powell yesterday at the Economic Club of New York in his speech and then in his fireside chat with Bloomberg's David Weston, I came away, and I think the market came away with, all right, the Fed is going to stay on hold here, but they're also keeping future hikes on the table. That seemed to be the message, and that seemed to be the consistent message. Let's see if it's the same message that the good folks at Citi are talking about. Stephen Whiting, he's a chief investment strategist at Citi Global Wealth. So, Stephen, again, it appears that this Federal Reserve is comfortable with where we are on rates here, and maybe even another rate hike on the table. Is that how you guys are thinking about it over there at Citigroup?
I think that was the message of Chairman Powell. He acknowledged that we're making progress. Of course, he pointed to backward-looking inflation is still too high. It's always kind of difficult to have core inflation at 2% when shelter price inflation is still about 7.5%. That's 45% of the core.
Yep.
So the issue is he's acknowledging the progress, and he's especially acknowledging that some of these softer measures of the tightness of the labor market have come off. That the forward-looking signs are weaker, and that the Fed is already at a restrictive policy stance, and it gets more restrictive every month with quantitative tightening. So I think that, again, he's really trying to say that, yes, we've achieved a lot, but we're not going to take it for granted that we are absolutely done. So he's not taking that notion out that the Fed still has the option of tightening further.
I mean, if they're restrictive now, I would hate to see what it really looks like when they get tight. I mean, 5.4% growth is what we're seeing in the Atlanta Now GDP forecast.
Well, that's really not indicative of the year. No, it's not. It's really indicative quarter-to-quarter volatility in the economy. And no, we're not in the environment where we were in 2020, where we had plus or minus 30% quarter-to-quarter GDP. But I think a lot of things have surprised to the upside. We've raised our economic forecast as of August by a full 1.5% for the year. What's the striking part of all of this?
What are your forecasts for the year, Stephen? I mean, set us up.
For full year, 2.3 for full year GDP, slowing about a 0.5 percentage point, so to about 1.8 in the coming year. And if anything, it could be a little bit more attenuated, the strength and the slowdown a little bit. The really striking thing about the economy is that in the year past, the growth rate of employment exceeded the growth rate of GDP by the most since 1974.
Wow.
Not a good year.
Wow.
Right? So profits have fallen. We've gone through what I would say is in the manufacturing and trade sectors and components of the housing sector, we've already gone through a recessionary adjustment, at least a mild one. And yet employment growth has been this strong. I think that changes in the coming year, and that we're likely to get some rebound in profits while headcount is going to be a lot more stable. So I think that's the optimistic call for rates. If we just continue to see, regardless of how the economy does, regardless of tightening in monetary policy, employment still rages on, well, then you still have the existing problems that markets have now in not knowing where the top is on rates.
But do you think that turns around, Stephen? I mean, if employment growth was stronger than economic growth in the past year, in the next year, as economic growth slows down, does employment growth take a leg even lower than that? I mean, do we start to
I think we're headed to a jobless recovery. Yeah, I think we're headed to a period in which, there's no V in the economy. There's no collapse in everything everywhere all at once that everybody's waiting for, like 2020, where it's as clear as day. It can only get better. It's not that. But employment growth, just the industry composition of employment growth, the recovery in services, which took a depression, strange imposed depression in industries that normally don't even fire people, that rebound in services really drove that outperformance of the labor market. And I think it's going to slow. And at the same time, there are areas that are just long cycle. Multifamily construction, for example. Now, construction is an industry that normally has, double-digit gains and losses around recessions. It's only slowed. And that's despite a 21% drop in residential investment. But what's happened here is the longer cycle components of construction, multifamily housing, which takes 3 years of construction time, 4 years of planning. Well, activity right now is still demanding a lot of labor. And it's at a record high share of total construction activity. So that is going to come off. And I think everyone assumes that there's been this really short policy lag. Hey, everybody can get used to the Fed quickly. That might be true in financial markets, but it's not true in the economy. So I think we're headed for a slower labor market in the coming year, despite the fact that profits down in the last year will probably recover a little. Less than consensus, but they're on their way up.
All right, Stephen, given that economic backdrop, what's the investment call coming out of Citi these days? What are you telling clients to do?
Well, look, I think this current period of greater concern about security is something we can't dispute. We can't tell everyone, are we certain that there's no widespread conflict? History shows that in more than 90% of cases, that is true. We're not going to change and create a turning point for the world over regional security issues. I think for the equities markets, everyone has said, well, if we don't know where the top is in rates and oil, then we have issues. But broadly speaking, we've restored value in both stocks and bonds. We've restored, again, near record high real interest rates. If you look at the TIPS markets, again, 2.5% government guaranteed bond yields plus inflation compensation. Think about that. 6% corporate bonds. Now here's another one. Small and mid-cap growth companies, those with good balance sheets and profits, not the ones that have levered up, are trading about 30% below their long-term valuation average, down by a 15 PE multiple. So we started to add there. Not taking a whole lot of aggregate risk, but it's time to recognize those growth opportunities.
We don't see a lot of bargains, do we, Stephen? Because I hear Torsten Slok, I think a couple days ago, sent out a PE for the Magnificent Seven, which was like 45, and for the S&P 493, which was still 19. Now I've heard others say it's more like 16, but it's not terribly below the historical average. And then in terms of credit, you don't see spreads wide. They're still pretty tight.
Well, this is, again, the reason why we're not investing along the lines of just adding S&P 500. For large cap exposure, we're doing equal weight S&P, and we're overweighting, again, within a neutral global allocation for small and mid-cap companies. We found true bargains at small and mid-cap growth companies 15 times. The long-term average PE for the sector is 21 times. Now, it's not Russell 2000. Again, that's companies that have grown their earnings about 12% per year for the last 10 years, and largely exclude things like banks that have levered up in the small cap area.